are high and inflation's coming down? Or is policy not so tight because financial conditions have eased significantly, and that's providing support to the economy? If you look at the Atlanta Fed GDP now forecast for the fourth quarter, it's now tracking 2.6% after a 5.2% growth rate in the third quarter. So it's not really clear that the economy needs a lot more accommodation to support itself.
Bill, do you think the Fed Chair Jay Powell understood what he was going to do to markets?
I think that he certainly, I hope he understood that he was coming across with a very optimistic sort of framework for the markets to digest. I think that it's true, as Austin Goolsbee said a little bit earlier, that this is a forecast. And so if the forecast doesn't materialize, then the Fed rate cuts that are promised won't materialize either. So the market may be getting a little bit ahead of itself. This is how Powell thinks the world is going to evolve. Powell thinks the Fed's going to be cutting rates in 2024. But it's possible that the economy could be firmer for longer, inflation could be more stubborn, and the rate cuts might not actually turn out to materialize.
The reason why I ask that is because Fed Chair Powell had an opportunity to push back against the financial conditions and the easing that we have seen. He had a chance to say, this is problematic and moves counter to our goal of bringing inflation down. He didn't. And you're saying financial conditions still matter. So why do they still matter? Is it becoming inflationary, or at least not necessarily restrictive in a way that's problematic for the Fed to see financial conditions easing as much as you've pointed out they have?
Well, the big problem here is that if financial conditions ease a lot, that provides impetus to economic growth. If the economy grows faster, the labor market's tighter, wage inflation's higher, and then it's harder to actually achieve your 2% inflation objective. So the question is, does the economy need more fuel? Does the economy need to grow faster? I would say probably no. The labor market's already very, very tight. Wage inflation, as Powell has acknowledged, is above a level consistent with 2% inflation. So I'm not sure why you'd want to put more fuel on the fire.
But do you think we've learned enough about the cycle so far, though, to draw conclusions about the contribution of the labour market to overall price pressure and just discount it and say it's not as important as we thought it was?
Well, I think it's true that there was a big labor force supply benefit that you got last year. A lot of people rejoined the labor force. So the Fed had its cake and eat it too. They had pretty sturdy growth, but it didn't generate inflation pressure because the labor force expanded to accommodate that growth. Now, the question is that going to continue in 2024? That's a really important question in the economic outlook. Are we going to continue to see that kind of rapid labor force growth that accommodates payroll gains of 150, 175,000, 200,000 a month?
Do you see reason to believe that it won't?
I think that there's some reason to believe that some of the labor force growth we saw last year was a catch-up. Right. Basically, you opened up immigration again, so you had a surge of immigration, of legal immigration into the U.S. last year. Work from home allowed working age women to re-enter the labor force. But whether that trend is going to continue at that pace, I would be a bit skeptical about that.
There seems to be an acceptance or re-acceptance of the concept of transitory at Fed Chair, among the Fed officials, particularly Fed Chair Jay Powell. Are you pushing back on that? Are you saying it's still too early to say that there's still stickier aspects to inflation that they're discounting?
Well, I think a lot of the inflation pressure clearly was transitory. A lot of the upward pressure you saw on goods prices was just due to the pandemic and people increasing their demand for goods temporarily during that shutdown period. Now, when you've opened up the economy, the demand for goods falls, and so all that price pressure goes away. I think the problem on inflation is really more about pressure on resources in the labor market. The labor market is still very, very tight. Wage inflation is still too high. And if the economy grows at an above-trend pace in 2024, all that pressure on the labor market is going to increase rather than diminish. So the real question I have in my mind is the monetary policy as tight as the Fed thinks it is? And I think the fact that the Fed has pivoted in this way by easing financial conditions, that makes monetary policy less restrictive rather than more restrictive going forward.
Some people have speculated that the Fed wants to cut rates in the first half of the year and avoid making any moves whatsoever in the second half because of the presidential election. Do you buy into that?
No, I don't buy into it. I think at the end of the day, the Fed acts in a completely apolitical manner because they understand that if they start timing rate cuts or rate increases with the political cycle, that politicizes the Fed and puts them in the middle of the whole debate. So the best thing the Fed can do is they totally ignore the political cycle and do what they think is best to achieve their dual mandate objectives.
Let's just sit on the comments we've heard so far. We've had clarifying remarks from New York Fed President John Williams, your old seat, Bill, clarifying remarks from Goolsbee over the weekend, from Mester this morning in the Financial Times. Bill, how does that work? These speeches, these interviews are scheduled well ahead of time, as we know. Is there someone on the committee the Board of Governors that sends out a message to everyone and says, let's all get on the same page. I need you to say XYZ, Bill. Does that ever happen?
So the answer is yes and no. Yes, John Williams, when John Williams speaks, you have to believe that that's been carefully choreographed with the Board of Governors and Jay Powell. When other Fed presidents speak, no, that's not choreographed. That's them operating on their own. So Powell speaks, you want to pay, Powell speaks, you want to pay attention. John Williams speaks, you want to pay attention because they're part of the troika, the core group that sets monetary policy for the Fed. So I think, look, I think people are pushing back a little bit. I think the market is sort of running away from them when the story isn't really completed yet. I mean, Powell's remarks last week were all about how he thinks things are going to evolve. We have to see if they actually evolve in that way to provide the motivation for rate cuts.
Hey, Bill, appreciate the update. Great piece this morning. Enjoyed the read. Bill Dudley there of Bloomberg Opinion on the gamble he thinks this Federal Reserve is taking with the grand pivot that was seemingly unofficially announced in last week's news conference.
The idea of who to listen to and how it's choreographed. If John Williams was choreographed pretty carefully, I guess they were saying, all right, can you calibrate this rally? And he's like, all right, I will. We weren't really talking about it.
He had to say we aren't really talking about it. What was the chair doing talking about it?
Well, and that's the reason why nobody listened, right? But this is exactly it, that people don't know why they should listen to it. If clearly they did have a conversation and it's clear that it's something in the discourse, if data cooperates, yes, but you can't really put that genie back in the bottle.
Let's imagine the person who's got to edit the minutes. Spare a thought. What do the minutes look like now? We didn't talk about it.
We did not talk about it, and
just, draw a line out.
It's really important that we remain vigilant.
Okay.
The last mile,
Sure.
pain, more pain.
And then we're going to sit there and say, well, where was it coming from in the news conference? And I don't get it.
No, we don't have to even show up because we already did that.
Next hour on Bloomberg TV, Kate Moore of BlackRock, Jared Woodard of Bank of America, Laurie Heinel at State Street. Lots of questions on basically what was Chairman Powell doing last Wednesday and how credible is the pushback since then? Or do you just ignore it and keep on buying this equity market? Because that's what's been happening now for the last 7 weeks on the S&P 500. Can you make it week 8? Equity futures up here by 0.25% on the S&P. In the bond market, yields going nowhere, 3.90 on a 10-year. In foreign exchange, the euro 109.21. We said it a few times already this morning. Your pushback is only as credible as the data behind it. For the ECB, the data behind that pushback is absolutely terrible. From New York City, this is Bloomberg.
used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
An hour before the New York Open. Welcome back. This is Bloomberg Surveillance. Tom Keene, Jonathan Ferro, Lisa Abramowitz. Tom off today. John off to prep for his 9 a.m. hour. And what we see is a lift to the market following 7 straight weeks of gains, the longest streak since 2017. You could see that really on a broad-based level. It has been led by the small caps, by the banks, by everything that gotten beaten up. The S&P now up about 0.25%, near those targets for year-end next year. Euro dollar 109.24. 10-year yields up just fractionally, but stable at 391. When I'm watching, Treasuries had their best weekly performance since March 2020. At what point do people start to wake up to some of the same concerns from earlier in the year, like the budget deficit, like who's going to be buying all this debt? A lot of those have been pushed aside with the wall of cash. But on the fiscal side, there still are a whole host of questions, especially leading into the end of the year and heading up for a tumultuous January. Anne-Marie Hordern back with us, Bloomberg Washington correspondent. And Anne-Marie, I want to get your take on what the timeline is. We do have Senate back in session trying to get a couple of things done before they go away for the holidays. A lot of key deadlines coming, though, in the next 4 weeks.
Yeah, I mean, your guess is as good as a lot of senators at the moment. Some mixed messaging over the weekend. But I think what most people are gravitating towards is that the fact that they have made some progress when it comes to this comprehensive deal for Ukraine aid in lieu of more border security and potentially also in changing some immigration provisions. But the fact of the matter is, will they be able to vote on it this week? That's the big question, as Senate Majority Leader Chuck Schumer called all the senators back to try to get a deal done this week. He said there would be a vote this week, but Senate Minority Leader Mitch McConnell, along with James Lankford, the senator that's the main Republican negotiator in this border deal, they said that likely there will not be a vote this week in a private letter to their colleagues. So that remains to be seen potentially if we will get what Terry Haynes is calling an 80% chance of a deal in principle. So potentially by the end of the week, there could be an outline, a deal in principle, a negotiation. We do know the White House is stepping up efforts. We have Alejandro Mayorkas, the Homeland Security official, part of these negotiations over the weekend. But Lisa, could there be a vote? And then this bleeds into the new year, where things get even more complicated because we have a laddered approach when it comes to potential government shutdowns.
Is anyone talking about actually reducing the deficit at this point?
Well, yes, people talk about it, but are they acting on it at this moment? No. I mean, the House has left. Mostly it's where the House, where these kind of deals should be originating when it comes to the fiscal purse of the United States. But when it comes to the deficit, the Republicans maintain that they want to lower the deficit, which is why they want these top-line numbers to be much lower going into the appropriations debates. And all of this is going to really accumulate in the first few weeks of January. The first part of that laddered approach for the government, maintaining the government to be open, is January 19th and then February 2nd. So you're going to hear a lot about fiscal responsibility come the start of the new year. All of these problems are being pushed into the start of 2024.
Just going back to the border control issue, I just want to get your sense. What are the main contours of the disagreement between the Democrats and the Republicans, and frankly within the parties as well?
Well, it's not the fact that the President of the United States has talked about having a more secure border and sending more money there. Republicans, by and large, agree on all of that. But this comes down to asylum provisions and parole provisions. So asylum, who should be granted asylum into the United States? Should those rules be tougher? And then also, once you're in the United States, how does the laws reflect the fact that individuals can work until they are called before a judge? So it's all about asylum, it's all about parole, and this is where the crux of the debate is at right now between the Republicans and the Democrats. But Republicans have made it very clear, Lisa, if there is no broader security package that includes provisions in asylum and in parole, then they're not going to allow for Ukraine aid to go through.
Anne-Marie Hordern, thank you so much. As always, we'll be catching up with you throughout the week and weeks to come as we try to understand exactly how much we're going to end up with another government shutdown. Right now, markets, everyone's trying to understand just how dovish Fed Chair Jay Powell was, especially given some of the pushback we've heard from colleagues at the Fed. Kathy Bostancic, among them, chief economist at Nationwide Mutual Insurance. How much has your view, Kathy, changed since last week?
Good morning, Lisa. It hasn't really changed all that much, to be honest. We were expecting rate cuts to unfold in the middle part of the year. We have May, as our exact forecast. That's always tough to tell, but we had the Fed funds rate going down to 4 and 4.25 by the end of the year. I guess the difference for us is that we had baked in, and we still do, a mild recession that unfolds in the middle part of next year. I think what surprised me was just how open and transparent Chairman Powell was. Doesn't surprise me. They were talking to some degree about rate cuts. They obviously didn't go into a lot of degree. I don't think so, right? And the timing, they didn't discuss that. But if you look at the dot plot estimates, they added another rate cut for next year. Of course, that had to be somewhat discussed. But I was struck by how dovish his comments were. That just fed the markets.
Well, a lot of people might argue that he was just being honest and transparent about what they were actually thinking about, and they didn't see an easing in financial conditions as a concern for prolonging this cycle. Do you agree with that? Do you think financial conditions are less important at this point?
Well, I think financial conditions are very important. But I think what he has said in the past makes sense. At least the recent past is we're going to have our, projections. We're going to conduct monetary policy we see best, and the markets are going to do their thing. And eventually, that will be reconciled one way or the other. The most recent past, it was reconciled in favor of the Fed. But now we have the markets, running far ahead. I mean, there's some risks to that, right? If inflation doesn't continue to disinflate as expected, rental inflation could be a little stickier. On the other hand, you could say, well, what the financial conditions are doing does help ensure a soft landing, and maybe that's okay, right? In the timing of it, whether they cut rates in March, that does seem a bit premature to us, but towards the middle of the year seems reasonable, and it could come in May.
Let's talk about some of the potential scenarios. I'm really struck by the story about the Red Sea shipping channel that accounts for about 12% of all container shipping activity in the world. I'm just wondering, the blockage of this, the fact that you have more and more container companies stopping some of their transit through that passageway, are things like that on your radar to be sort of a shock, a supply-side shock that could get reinstated once again?
Yeah, no, I think that's a great point. We've seen that movie play before, and we know that it can have large ripple effects. So whether supply chains or some other exogenous shock, it certainly can play havoc with the expectations the markets have, and also even the Fed Reserve. Certainly, we watch that. But what we have seen is really overall supply chains in much healthier shape, and domestic demand's activity is slowing. Now, we may not get the mild recession we're forecasting. Even if you get a soft landing, you're going to have slower growth. That takes pressure off of inflation, especially in the goods market. we look at China, right? China's struggling and their domestic demand's weak. It looks like they're pushing out their goods onto the global market. That only kind of reinforces deflation in the goods sector.
So this is a reason why maybe Fed Chair Jay Powell leaned in, because you are seeing this disinflation continue. The pushback, though, does continue from other Fed officials. Austin Goolsbee commenting right now, Chicago Fed president, he's saying that he does see significant improvement on the inflation front, but was a bit surprised by the market reaction. Do you think, Kathy, that people are over their skis with the number of rate cuts that the Fed could potentially make next year? Or do you think that people are over their skis with understanding the potential pain that could come through the economy?
I think both, actually. I think, again, we're forecasting essentially what the markets have priced in terms of by year end with the Fed funds, but that was assuming a mild recession where the unemployment rate goes up to about 5%. If the Fed is successful in pulling off the soft landing, I would make the case that you get a little less, rate cuts. I would think what they forecast is more reasonable, and they are going to be, the stronger and more resilient economic activity is, the more cautious I think they're going to be on the inflation part. Yes, things are going in the right way, but the last thing they want to do is see some stalling out of inflation. We're not even talking an upward reversal. Just a stalling out. And I think economic activity, listen, one thing that, isn't talked about a lot is if inflation continues to go lower, as we all think, that means companies lose some pricing power, and that hurts revenue and top line, unless they can make it up in volume. But if the growth is slowing, I don't really see that. So I think you still have some profit margin pressure, as you look into 2024.
Do you think that the weakness is coming from just savings being spent up, that story that people kept saying, and then we were waiting for it and waiting for it? Or do you think that we're seeing more cracks in the labor market than people really appreciate?
Yeah, so I think the savings is largely, the pandemic-related savings have largely been spent. We did a good job of going through $2.1 trillion, right, as a U.S. consumer. And I think if you look at the labor market, if you look at the cyclical portions, especially in the service sector, you're seeing a notable slowing. I mean, where the job gains came on the service side were health and education. Now, that's not going to be affected by interest rates and cyclical as much. So if you strip that out, core private service jobs are down to 22,000. So I do think we're seeing a slowing. And I think the Fed maybe also sees that and wants to make sure, now they've gotten close, right, to possibly pulling off this soft landing. Now they can get a little greedy and say, well, at one point we would have accepted a mild recession. The most important part is getting inflation down. Now they're saying, well, now we have to consider both sides of the mandate, right, employment as well. So
is core PCE important coming out on Friday?
Oh yeah, no, absolutely important. I would say now we have already gotten the CPI data for November, so there shouldn't be a huge mystery. But if it surprises, I do think that changes things a little bit, right, in terms of the calculus. It's always important, the core PCE, but I don't anticipate it changing the momentum, what we're seeing in the marketplace. I think we're the bulls are out of in both the bond and the equity market at this point.
Kathy Bostjancic of Nationwide, thank you for being with us. Stay close. If you are just joining the program, we do see a lift to markets to start a potential 8th straight weeks of gains right now throughout the market. You are seeing yields a little bit higher, 3.92%, but the S&P, after 7 straight weeks of gain, 47.79, up about 0.25% in early trading. We are talking with Kathy Bostjancic of Nationwide about the different potential risk scenarios going into next year. One thing we haven't talked about is the deficit and some of the politics. Do you see that as really having any material impact on the economic outlook at a time when a lot of people have just continually, at least in the market, shrugged off all of the sort of turmoil in Washington?
Well, that could be some kind of exogenous shock on the political front. That's something. There's still a lot of dysfunction there, but I think in terms of the fiscal front, what we expect is very little, easing in fiscal policy. Even if we have a rough patch, that's politically is not going to happen. But also, I think they're still trying to decide whether, what the spending bills will be for next year, and I do think there's pressure, especially from the Republicans, to try to rein in the deficit. what's not talked about as much is that really the pressure is coming from entitlement spending, which is, persistent. That's a secular issue. And also the fact that interest rates are now, even though we've come off quite a bit, its interest costs are high. If you look at discretionary spending, that's really been squeezed. Year after year, that continues to be squeezed, excluding the pandemic. They may continue to try to squeeze that more, but the one area that probably doesn't get squeezed is defense spending, right? I think with the multiple wars going globally and the fact that we need to, continuing to read that we need to replenish our own arms, that's probably one area where we continue to see spending.
Kathy Bosancic of Nationwide, thank you so much. Going forward, we're going to be speaking about the situation in the Red Sea. Kevin Book of Clearview Energy Partners joining us next as we parse through a massive corridor for everything from oil to container ships. This is Bloomberg.
The acceptance of Purasango has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Purasango all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So 250,000 cars in a market where there are million and million of cars every year.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Could face bigger challenges next.
It was going to keep rain World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
The region has not kind of been a safe area for shipping for a very, very long time. But now it's been escalating kind of beyond what we've seen for, at any point in time, really. So it's a huge kind of risk concern. We're afraid that it's only a question of time until kind of we see a ship that's completely kind of unrelated to Israel or any parts of the conflict will be attacked.
That was Lars Bausted, Frontline CEO, in response to a number of the attacks in the Red Sea by Houthi militants, which has led to a host of container shipping companies, as well as the latest being BP coming out and saying they were halting their Red Sea voyages. Welcome back. This is Bloomberg Surveillance. We want to take a look, in addition to the lift to the market, some of the names underneath. There was this big acquisition, Nippon Steel buying United States Steel Corp for $14.1 billion. This does create the world's second largest steel company and the biggest outside of China. This raises questions about the ownership and whether Japan's biggest steel producer will be allowed to buy U.S. steel, but also is really kind of a lifeline for U.S. Steel after a lot of speculation of what would happen and a lot of trouble with the finances. Those shares up by 29%. And BP, this is really the story that we're watching this morning. How many companies are going to stop shipping their goods through the Red Sea in response to these Houthi militant attacks? BP is the latest coming out and saying that they cannot risk it. Those shares up 2%, almost 2%, 1.9% in tandem with oil prices that are moving higher as well. Kevin Book has been covering this, trying to understand the implications, and I'm so pleased to say joins us now, co-founder of Clearview Energy Partners. Kevin, can we just start by trying to understand how important this Red Sea passage really is for shipping?
Lisa, good morning. Thanks for having me. It's 8% of global LNG, about 9% of global oil and petroleum products. So an enormous amount of energy that goes into the world goes through the Red Sea.
So what is the potential consequence if these attacks do continue? How much more time is required to ship things in alternate routes? How much more energy will be used, oil will be used for those shipping routes?
Is relatively insignificant compared to the supply impact. There's two aspects to this. The first is the additional latency introduced by going through the Suez Canal and then around Africa, and that depending on the speed of the ships moving, and they do move somewhere between 10 and 14 knots. You could have anywhere from between 10 days to two weeks, even a little longer. The second is capacity constraints on the Suez Canal itself, and to some degree, the number of ships that move through is one aspect of it. They're also the size of the ships that move through. The Suez Max tanker size is so called because it's the maximum size tanker you can move through the Suez Canal. And obviously the limitations in fleet capacity can introduce additional pinch on supply.
Right now, crude traded on the NYMEX is up 2.3%. Is this sort of appropriate in your view? Do you think that we should see an even bigger pop in oil prices just simply because of the supply constraints that could come from prolonged shipping passages?
Well, yeah, we thought it was significant when we wrote about it a week ago, and we noted how odd it was that the market wasn't yet pricing it in. As for the magnitude of the increase to date, I mean, obviously the numbers I gave you would be staggering. If that amount of supply was disabled, we would see double-digit moves in the oil price on a dollar per barrel basis. But a lot of this depends on really the decisions that actors make, and there's a lot of players in this. Questions about whether or not the Saudis, for example, will continue to ship through the Red Sea, and whether or not they believe they're at risk of attacks. The risk tolerances of other players, and for that matter, the evolution of the task force that the U.S. government is working right now actively to stand up with other players in the region, emulating a similar task force in the Strait of Hormuz. Last variable, not to make this more complicated, is the question whether or not the Eisenhower carrier strike group, which moved into position potentially to strike the Houthis, risks a different kind of escalation that could produce reprisals in other parts of the region.
Given all of those variables, what's the appropriate price for oil?
Well, we thought we saw pressure to the upside a week ago. We're seeing it now. We think there's room for more.
At this point, what kind of response would be de-escalatory versus escalatory, right? There's this this group that you said is trying to come together to come up with a way to deter Houthi militants. What are you looking for as a response that could relieve some of the pressure on oil versus the opposite?
Well, it really depends on the root cause of the problem here. The Houthis seem to be doing something that's fundamentally and conceptually similar to U.S. secondary sanctions. Initially, they started targeting anything with nexus to Israel, Israeli ownership or management of the shipping company or the tanker, or for that matter, just cargoes going into or out of Israel. They've cast the net even more broadly now. A stand down, some sort of accommodation that they have a narrower focus, that kind of thing might potentially take some pressure off. The maritime task force, to the degree that it can provide security for tankers in the region, might not eliminate the risk premium, but it could potentially keep it from rising.
At this point, a lot of people are discounting a lot of the geopolitics, simply saying the U.S. is pumping record amounts of shale. Gasoline prices, on average, in the United States are basically $3 on average, and you can see that across the nation. How much does U.S. production offset a lot of the potential geopolitical headwinds that could cause prices to rise?
Well, so there's two things that are really offsetting, and one is, of course, the prolific production here in Guyana and in Brazil. You're seeing non-OPEC production surging, and that has buffered prices. And of course, we can't overlook demand weakness in China. But the other side of that is that the supply cushion that you get from spare capacity from OPEC producers is usually something else that can come to the rescue. But in this case, that supply cushion is less available because part of that supply could potentially come out through some of the very same choke points that we're discussing today. So for that reason, I think we may see more risk showing up in price perceptions as we go forward. But yeah, we've been sleeping through some very serious potential supply risks for some time, very reassured by production.
Well, this is the reason why some people are wondering, what did they get wrong? How much do you think is that the demand side is offset by the increase in electric vehicle use and other alternative sources of energy?
Well, so every million electric vehicles on U.S. roads, where we drive more with less efficient cars than other parts of the world, is only about 30,000 barrels per day of demand destruction. So we're selling more than 1 million a year. That's not really showing up that much. We're getting bigger displacements, but still, that's not changing the demand picture. Demand is going ahead, at least in the near term. There are a lot of folks who would say that maybe the predictions of a plateau or even a peak this decade are even premature. So with that in mind, I think we shouldn't discount that there's immense appetite for crude oil out there still, and liquids generally. And with that, supply risks still very much matter.
To put this all together, people have been talking about ranges heading into 2024, ranges that oil could move within, given the need to both not lose money on producing oil in the U.S. and also the desire for Saudi Arabia to make a certain amount per barrel. What is that range, given the risks and given the supplies that we've seen from the U.S.?
Well, the idea that there's sort of a natural 8-handle floor established by fiscal break-evens or other mathematical computations has a little bit, of I think, hopefulness to it. There's 2 active wars going on right now in energy-producing and consuming areas, with risks potentially in Venezuela as well, although they currently seem to have abated. With that in mind, I think it's a bit odd to look only at supply-demand balances and assume that the world as it is today will be how it is in the coming year. But if you do look at that, you see supply outstripping demand in the first half of the year. Our latest look, my colleague Jacques Rousseau looked ahead at it, and it looks like there's still weakness. And with OPEC Plus clamping down, the incremental clamp down isn't necessarily enough to stem it in the near term. But this is where geopolitics comes in. And always, it's important to remember, there's an alignment of incentives here. For Iran and for the other folks who are aligned with Iran, the idea of a higher oil price because of geopolitical risk isn't a bad thing, it's a tailwind.
Kevin Book of Clearview Energy, thank you so much for being with us at a time where oil prices are finally hitting a lift after a number of weeks, more than a month of losses, given the fact that people have seen the production from the U.S. offset some of the concerns from supply cuts and some of the other potential disruptions. Right now, what you are seeing in markets is a lift. Maybe week 8 of a rally that has been the longest going back to 2017, gaining some steam, up about a 1/3%, 47.83 as people parse through the economic data and see a soft landing. We are hearing pushback from Fed officials, including Chicago's Austin Goolsbee, once again saying, I think the market got a little over its skis. Relax. Market's not really buying it. It's maybe around the edges. Coming up on Bloomberg TV at 1 p.m., BlackRock's Rick Reeder. From New York, this is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
This is Bloomberg.
Let's get your trading week started. Live from New York City this morning. Good morning, good morning. This equity market still rallying. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, coming up, equity markets delivering 7 weeks of gains as Fed officials attempt to push back against pivot talk, and Goldman already lifting its outlook for next year. We begin with the big issue, the bears getting absolutely steamrolled.
Doves fly and bulls run. We've had a massive rally in equity.
Rally across risk assets.
Santa Claus rally. Quite a rally.
Right now, we're kind of in this Goldilocks phase.
The trade for today is the Fed's going to ease. What we learned from the Fed is that we have to start entertaining our bull case a little bit more.
That was a green light.
The bears have pivoted.
We have a relatively bullish view on the S&P 500 for the year ahead.
2024, we're going to play from the bullish side.
I think equities have a ways to go.
We have some room for risk to continue to rally.
You could see them test and challenge and surpass the old highs.
You can't really fight this until there's some kind of fundamental data from the economy side that pushes back.
Until we see data that it's not working, it's risk on.
It's risk on right now. Joining us to discuss BlackRock's Kate Moore, Bank of America's Jared Woodard. Kate, are there any bears left?
There are still a few holdouts, I think, John. I think there are a number of people who looked at the phenomenal move in the equity markets last week and risk assets kind of broadly and said, this is not sustainable. But no one wants to stand in front of this train going into year end. I think we'll see a lot of adjustment of positioning in January, however, and some of those bears will be a little bit bolder, especially if we rally over the next 2 weeks.
The bears are sounding bullish this morning. Mike Wilson of Morgan Stanley, a bullish outcome for stocks off the back of what we heard from Chairman Powell. Jared Woodard, are we setting ourselves up for disappointment? How high is the bar now going into 2024?
Yeah, I think it's fair to say, John, that the gains from this pivot by the Fed are fully reflected in the market. I mean, never mind the Santa Claus rally. This market, bonds and stocks alike, have trimmed the tree. They popped the champagne cork for New Year's. They booked a ticket for summer vacation. They're so far ahead of what the economic fundamentals would suggest. If anything, this is a great point to start taking profits and look for alternative positioning for next year.
Jared, you'd pull back. Where would you pull back?
Well, I'd take gains in unprofitable tech. That's been one of the things that's rallied the most in this short covering rally. And the most shorted stocks have been huge beneficiaries, as Kate mentioned, as bears pull back. But when you have low quality rallying and when you have fundamentals that haven't really improved sharply in the last several weeks, if anything, we think the risk of inflation in the second half of next year is still a big concern. So investing in things that are going to be robust to inflation and to things that are higher up in quality seems like a great way to position for next year at a time when everyone else is just scrambling for any kind of junk they can find.
It truly has been an everything rally. Breadth has improved. Kate, I just wonder from your perspective if that's the real deal or whether that's a head fake.
Yeah, look, I think there's a little bit of real deal and a little bit of head fake actually mixed in here, John. And on the one hand, you have seen a lot of people reposition, kind of invest in the laggards, rotate, try and neutralize some of their underweights. And on the other hand, there's this acknowledgement that, let's say, particularly in the small cap space, that had been under tremendous amount of pressure as rates continue to rise, that if the worst is behind us in terms of policy tightening, there is potential for some of these companies to perform okay. I'm not going to say phenomenal, but okay in 2024. So the earnings story has a little bit less downward pressure, I would say, in the small cap space. So there's both the repositioning, I think, and an acknowledgement the fundamentals could improve.
Okay, talk to me about the sectors you do like, tech and discretionary. Are the winners of this year the winners of next year?
Yeah, we like tech, discretionary, but we're looking for opportunities, John, across all sectors at this point. I might take a little bit more of a bullish look and a little bit more constructive than Jared right now and say, yes, it's true that we've started to price in a lot of the best news from the monetary policy front, but there's a lot of good fundamental stories across all of the sectors at this point. Companies have done the work in terms of reducing their expenses. They continue to manage to the bottom line, and I think they're going to deliver actually solid earnings across consumer, across technology enablers, and even some cyclical parts in 2024.
Jared, would you agree with that?
Yeah, look, when I mentioned going into higher quality, I'm thinking of companies and sectors where you have strong free cash flow with solid balance sheets that have already endured a lot of pain over the past decade. To me, that's financials, that's energy. We think about Asian equities in particular, Korea, Japan, India even, where you've got decent or even compelling valuation, lots of corporate reform, a positive macro environment, and if the consensus view is right, that you have a weaker dollar next year, a friendly Fed, those Asian stocks are really poised to benefit from a weaker dollar as well.
Jared, you mentioned the banks. Let's talk about them. On the S&P 500, they are higher by 26%. Not year to date, but since the end of October. Is that just off the back of the bond market move, or is there something sustainable in your mind that we're all missing?
Well, I think it's a few things. There's a taking out of some of the risk around real estate and some of those tail risk scenarios that have dogged the market this year. There's the understanding that a friendlier Fed, friendlier cost of capital is going to boost multiple lines of businesses across banks. And positioning here matters too. When people have been so bearish on especially larger cap banks all year, when you have a rally of this type, you would expect that some of those most shorted names to get an uplift.
Okay, what is there to like about the financials from your perspective?
I got to be honest, John, I'm not overly excited about the financials at this point. I'd be putting my incremental risk in maybe some different places. I mentioned discretionary before. We've had, a constructive view on the sector, but I could see a broadening out in terms of retail in particular. If we continue to have what we've seen, which is like strong wage growth, but not so strong, inflation continuing to cool, but I'm not talking about outright, aggressive deflation, stable monetary policy, and sentiment settling, you can see a broadening out in the discretionary space and across retail. And so that's a place I'm doing a little bit of work and getting more excited about. The banks, I just don't see a huge outperformance catalyst in 2024.
Jared, what are we missing? I'll ask that twice. What are we missing?
Well, I think the most important thing for investors to think about right now is what's priced in, what's reflected in the market today. And the consensus view on a perfect landing, slower growth, friendly and disinflation, and a Fed that's very happy to cut is, I think, fully reflected in the market. So my point earlier about being tactically a bit cautious reflects the fact that the market's already well ahead of the Fed. That's why you have folks coming out in the days after saying maybe people need to reconsider. That's why my colleagues at Bank of America just have the rate forecast for cuts next year, but which is still much less dovish than the market as a whole. If you're an investor approaching the market, from a neutral standing point today, I think you have to have a barbell of things that are tactically a little bit more cautious, but with looking for cyclical value opportunities for the second half of this year. Structural inflation, we think, is a really big theme. That means you need to be in equities, you need to be in commodities and assets that can benefit from a structurally higher stagflationary or inflationary environment. That doesn't mean you need to load up the boat at this moment, but it does mean that the asset mix that most investors have in benchmarks and model portfolios is ill-suited to the world as we see it today.
We'll come back to that. This market's still rallying about 23 minutes out from the opening bell. Equity futures positive here by 0.3% on the S&P. Let's get to Bloomberg's Katie Greifeld for more. Morning, Katie.
Morning, John. Well, we are officially on record watch. Futures show that the S&P 500 set to open just around 47.82. That's a breath away away from the index's record close just below 4,800 in January 2022. And it's been a really interesting road to get back here. The S&P 500 has surged almost 15% from late October alone. That's as traders priced in increasingly dramatic rate cuts. And it was looking like we were gearing up for another epic fight against the Fed. But after Jerome Powell's surprisingly dovish performance last week, maybe fighting the Fed worked out this time. And big tech bulls, they're certainly declaring victory. Even though we've really seen this rally broaden out over the last 2 months, that hasn't come at the expense of tech. The NASDAQ 100, as you can see right there, it's rocketed almost 18% higher since late October, outpacing the S&P 500. It closed at a record high on Friday and overall up about 50% in 2023, on track for the best year since 2009. Now, a lot of this equity rally, as you've pointed out, it's being fueled by the bond market. 10-year yields currently trading near 3.9%. For context, as you know, we were above 5% not too long ago. And while rising yields, maybe they weren't the stumbling block that bears expected, it certainly appears that investors think lower yields will help this rally. A note of caution would be the parade of Fed speakers that we've heard from in the last few days, including John Williams kicking us off on Friday, but so far not really making a dent.
Not a dent in any way, shape or form. Katie, thank you for the update. On the bond market today, yields higher by 4 basis points or so on a 10-year maturity. Let's call it 3.95 on that yield. Though, as Katie suggested, just a massive move in the last couple of months, both in equities and in bonds as well. Jared, you can't say stagflation then walk away. We've got to come back to it. Stagflation. Can you build on that a little bit more? Is that the kind of environment you're looking for next year?
I think in the second half of next year, there's a very meaningful risk that you see a rebound in inflation. And my colleagues in economics and across the firm, I think, have written about this as well as one of the risk scenarios. Because when you look at all the whole economy, it doesn't matter households, corporates, or government, all the major sectors are in an environment in which their sensitivity to rate hikes is extremely low. There's still, lots of risk of higher inflation, and many of the metrics that we watch are still 1 or 2 standard deviations above the long-term norm. I'll give you a couple quick examples. The U.S. federal budget deficit, 5% of GDP, unprecedented to be spending this much money with unemployment near record lows. And that's completely impervious for the Fed. People will tell you, John, oh, don't worry, Congress is going to pull back on spending next year. We think that's irrelevant. Our analysts have told me that something like 77% of the fiscal stimulus that's already been authorized by Congress in the last several years hasn't even been spent yet. That's going to still come through. Households and corporates, it's the same story. Households are sitting on excess savings, still around $950 billion. People very happy to buy houses at any price. Corporates are facing private credit dry powder to the tune of $500 billion. Very happy to step in and plug any gaps in lending that might come about. And it's worth noting, too, that high-yield issuers still sitting on big cash piles. The interest coverage ratio for high-yield bond issuers is still 1 standard deviation above the long-term average. This is something you see very early cycle, not end of cycle, and it's the kind of thing that if the Fed does cut aggressively, you could see a rebound in inflation. Given wage growth and all the other parts of the economy, they're still looking pretty hot.
Okay, what happens if Jared's right?
I mean, if inflation were to rebound, which I would say we put as a pretty low probability event in the second half of next year, because we do think we're going to see a steady deceleration in overall economic activity, perhaps not a big recession. I think we're kind of in a glide path here. But if we were to see a rebound in inflation, that certainly would be a big hit for risk appetite. If the Fed had to talk about normalizing policy further, that would be a big risk for the equity market. But I do want to make a point here about one of the risks for the second half of 2024 that we need to talk about, which is 2024 is an election year. And during election years, especially if there's a chance of a significant change in administration and policy, sometimes companies sit back a little bit and don't engage in capital expenditure outside of necessary and maintenance CapEx, right? They just sort of say, we'll do what's necessary, but let's see if there's a change in the tax regime or a change in regulation that's going to impact my ability to do business. So sometimes in the kind of the 4th year of a presidential cycle, during a big contested election, you will see a change in spending. So that I'm watching, which may lead to some dampness in the economy. It's not keeping me up at night, but it's something that's definitely a risk.
Okay, sit tight. Just going to stick with us. Kate Moore there alongside Jared Woodard. Right now in equity markets, about 17 minutes away from the opening bell. Futures still positive by 0.25%. With some movers this morning going into the opening bell, let's say good morning to Simone Foxman.
Yeah, good morning, John. M&A driving a lot of our biggest movers this morning. The big one, a $14.1 billion deal for U.S. steel. This coming from Nippon Steel in Japan. This would equate to about $55 a share in cash. You can see right now U.S. Steel in the pre-market trading relatively close to that. That's about 142% premium to Friday. You may remember this name had been the subject of a bidding war, but those offers were like $32, $35 a share, so much higher. Also an M&A, Adobe and Figma scrapping their $20 billion merger pact after Adobe saying it wouldn't make some changes to win approval from the UK's Competition and Markets Authority. Shares there higher in the pre-market. Also watching Coinbase. The SEC rejected its proposal for new regulations for the digital asset sector. Now the company is going back to the appeals court asking the SEC to be forced to move forward with new rules. We saw Bitcoin briefly drop below $41,000. It is among, Coinbase is among other crypto-tied names that are falling this morning, John.
Simone, thank you. More from Simone around the opening bell. Coming up on this program, pushing back against Pivot Talk.
We've made a lot of progress in 2023, but I still caution everybody, it's not done. And so the data is going to drive what's going to happen to rates. For sure, it's too early to declare victory.
Conversation up next.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Of when will it become appropriate to begin dialing back the amount of policy restraint in place that begins to come into view and is clearly a topic of discussion out in the world and also a discussion for us at our meeting today.
That was Wednesday. Chairman Powell adding fuel to the pivot party, prompting pushback from a growing number of Fed officials looking to temper rate cut expectations. New York Fed President John Williams leading the charge on Friday, saying bets on a March reduction are premature, emphasizing, quote, we aren't really talking about rate cuts. Austin Goolsbee of Chicago also weighing in.
2023 looks like it's going to end up being a very substantial reduction in inflation without a big increase in the unemployment rate. That's the golden path that I talked about. But we're still above the target. I still caution everybody, it's not done. And so the data is going to drive what's going to happen to rates. For sure, it's too early to declare victory.
Bloomberg's Ira Jersey joining us now for more. Ira, did you get all of that? Have we got a clear picture now?
Yeah, no, it's a more muddled picture, I think, John. I think that's pretty clear. I agree with the speakers actually since Jay Powell, right? The Federal Reserve, I think in general, wants to be on hold and wants to be data dependent. The problem is that the market seems to think that either the Fed's hiking or it's easing. It can't just stay on hold for a long period of time. And I think the challenge that the Fed's having is communication. It's saying, look, we're going to be on hold until one of these two things breaks. Either unemployment goes way higher or inflation is at or near our target. And I think Jay Powell didn't do a great job communicating that last week. So that's one reason why you had the very substantial rally in a relatively illiquid December market.
Ira, why do you think we're holding on to encouragement and ignoring the pushback that we've had from Fed officials?
Yeah, I think the market, people, well, for one thing, in the rate market in particular, we were having such a bad year just 2 months ago. And now that we've had this massive rally, I think people just want to square up positions, go home, have a nice holiday, just be flat the market, and then come in next year and try to figure out how to position based on maybe the next payrolls report and CPI, which we still get relatively early in January. You will probably see a little bit of profit taking, I would imagine. You look at some of the survey data on Treasury sentiment, for example, the JP Morgan data came out over the weekend, and that showed that a lot of longs are now more flat in terms of Treasury positioning. So, and I think we'll see a little bit more of that. So, but that being said, I think 4% plus or minus 10 basis points is probably where we'll end the year on 10-year yields.
All right, we've had a big conversation throughout this morning about the difference between cutting interest rates and easing with a focus on the real rate. From the market's perspective, Ira, a question that I've lent on this morning, do you think that's a distinction without a difference for financial markets?
Well, I think there is a little bit of question in that, because when you listen to Chris Waller, and what he mentioned was, well, look, if inflation's coming down, we're getting more restrictive, right? So that idea that the real Fed funds rate is actually going up as inflation comes down, and the market, I think, has kind of leaned into that a little bit, and certainly what Jay Powell said kind of had some confirmation bias to that. But that being said, you look at what real rates have done in the market, and TIPS real yields now at 1.75% on 10-year TIPS. That means that the market at least thinks that there's going to be much easier monetary policy going forward, as opposed to when we were 75 basis points higher in terms of real yields. So yeah, I do think that the market is leading into these individual statements that are being made instead of looking at the totality of what everyone's saying at the Fed right now.
Ira Jersey, thank you, sir, of Bloomberg Intelligence on the latest. A final word with Kate Moore, please. Kate, let's go there. The Federal Reserve. Who do I listen to? The Chairman Powell that I heard from at the start of December, the one I heard from on Wednesday, the people I've heard from subsequently. Who do I listen to?
I think we listen to them all, John. That's not a cop-out answer. I mean, I think Powell was right in indicating that we can start discussing the possibility of rate cuts if the growth, inflation, and employment data suggest that's the right and appropriate move. But I think, the other Fed speakers who've come out and basically said, hey, we're not promising rate cuts in the near term, that there's a lot of uncertainty in the macro data, that we're still coming out of a very unusual cycle from the pandemic, and we have to wait and see, is also worth paying attention to. I mean, I think the message for markets is, don't get ahead of yourself in expecting a huge number of rate cuts in the first half of 2024. We still think growth is going to look quite good. Some of the disinflationary pressures, or the speed of disinflation, may ease a little bit in the first part of 2024. But that doesn't mean, and I'm going to make another pitch for this, that it's game over for equities. I still think there's a risk-on move to be had, John, going into 2024.
Are there some basic underlying assumptions you're making on the bond market, though, Kate, to make that call?
Yeah, that's right. I mean, to Ira's point, I would expect stability in yields. If we had a huge amount of bond volatility, if we ended up seeing, let's say, a sustainable rise above 410, and there was upward pressure, I think that would be a little bit tougher case for equities. But I do think we're going to be able to move past the obsession with monetary policy, the obsession with Fed speak, and focus a little bit more on fundamentals, which I think are going to improve. And by fundamentals, I mean specifically earnings next year.
Kate, I hope that is not just a dream. That is actually a call. And it might actually materialize. You know, I think we're all on the same page. We all want to stop talking about this. Kate, thank you. Always fantastic to catch up with the brilliant Kate Moore of BlackRock, alongside Jared Woodard of Bank of America. Going into the opening bell, about 7 minutes away, equity futures still positive here by 0.2%, despite all of that pushback from Fed officials. Coming up next, the morning calls, and later, State Street's Laurie Heinel on why uncertainty is bound to persist in 2024. More still ahead from New York City. Good morning.
Connection lost.
The acceptance of Puro Sangue has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Puro Sangue all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So 250,000 cars in a market where there are million and million of cars every year.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets. China open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
New week, same story. 5 minutes out from the opening bell, the rally continues on the S&P 500, up by around about 1/3%. That's the price action. Let's get you some morning calls. Your first one from Guggenheim, upgrading Snap to buy. Analysts saying the demand for digital advertising is poised to increase and holds untapped potential. Your second call from JMP Securities, downgrading Shopify to market perform, citing profit margin headwinds and the stock's elevated valuation. That stock is negative by around about 1.6% in the pre-market. And your third and final call from the team at Truist, raising its price target on Dollar General to $125, saying the retailer is moving with urgency to improve in-store operations. That stock is positive by, let's say, 0.75% in early trading. About 4 minutes away from the opening bell. Coming up next on this program, State Street's Laurie Heinel on her 2024 outlook following 7 weeks of gains on the S&P 500. Are we set to make it week 8? Your equity market positive, your opening bell is just around the corner.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Seconds away from the opening bow this morning. Good morning. Your equity market positive by a third of 1% on the S&P 500 following 7 weeks of gains on the S&P 500, the longest weekly winning streak going back to November 2017. Can we make it week 8? The Nasdaq and the S&P slightly elevated going into the opening bow. There is your opening bow. Switch up the board and get to the bond market. Yields look like this on a 10-year, higher by 3 basis points. Your yield this morning, 3.9445. Getting tons of pushback from Fed officials. The ECB trying to sound hawkish. Let me tell you this. The pushback is only as credible as the data behind it, and the data in Europe is absolutely terrible. German business confidence, soft, weak. The PMIs out on Friday, not pretty at all. The euro holding on to 109.30 and positive by 0.3%. Crude rallying by 3 percentage points, 73.60 on WTI this morning. About 30 seconds into the session, here's the state of play for you on the S&P 500. We are just about positive by 0.2%. The Nasdaq Composite is totally unchanged. One stock to watch at the open, U.S. Steel. Japanese steel maker Nippon agreeing to buy the company for $14.1 billion. Simone Foxman has this one. Hey, Simone.
Hey, John. Yeah, what would happen to U.S. Steel had been the talk of the metals market ever since August. You may remember then it received some bids from the likes of Cleveland Cliffs, from S-Mark. Those bids were around $7.25 to $7.8 billion. None of them panned out, but the company did go forward with a strategic review, and apparently that was a smart move because Nippon agreeing to pay $14.1 billion in cash. That equates to about $55 a share, and that explains some of this dramatic pop that we are seeing, over 26% in the shares this morning. Now, the quick react from BMO here, surprisingly high price for U.S. Steel, and the union's strong support for the Cleveland Cliffs bid that had happened back in August, and that company's ability to maybe bid again could still complicate this transaction. But overall, U.S. Steel has been trying to transform itself, focus more on remelting scrap into steel rather than turning iron ore into steel. And overall, steel producers may really benefit from some of the Inflation Reduction Act programs, broader investment in green infrastructure, especially in the United States. Nippon also citing growing U.S. population. Either way, we can see a clear share reaction for U.S. Steel this morning. We're also seeing both Cleveland Cliffs and Nucor rising in early trading, John.
Up almost 27%. Simone, thanks for that. Let's stick with deals and check out the latest move from Warren Buffett, purchasing nearly $590 million of Oxy stock. Emily Grafea has the story. Morning, Emily.
Good morning, John. That's right. This latest purchase just adds to Warren Buffett's stake in Occidental. Berkshire Hathaway has been steadily increasing their shares of the energy company for the last 3 years. This latest $590 million stock purchase coming after Occidental announced that $10.8 billion deal with Crown Rock. Now, while Occidental likely didn't need Berkshire's support to fund this acquisition, it nonetheless shows a nod of approval from Warren Buffett that this deal is something that he approves of. Now, the shares up of Occidental right now, about 2% in the pre-market, down for the year, but I don't think Warren Buffett minds that stock was up 100% or over 100% in 2022, John.
Emily, thank you. Just short of 60 there. Energy stocks really underperforming, have not participated in the rally that we've seen more broadly on the S&P 500 and elsewhere. Stocks this morning just about positive, 3 minutes into the session, up by a third of 1%. The Nasdaq with a little lift, a small one, up by 0.2%. Let's turn to tech. Apple in the spotlight as additional Chinese government agencies order staff not to bring iPhones to work, according to our reporting. Alex Webb has the latest on this. Alex, how much worse is this getting for Apple over in China?
It's getting certainly quite a bit worse, but it's nowhere near catastrophic just yet. What we heard a few months ago is that, particularly in Beijing and Tianjin, that there was a pushback from some government agencies and state-owned companies, not least PetroChina, huge employer in that part of the world, forbidding them essentially from using Apple devices in the workplace. What we've now seen, according to Bloomberg reporting, is this is extended to 8 further regions. And now, Chinese government has said that this is not a top-down edict. The real question here is about the mood music, because these sales in and of themselves are unlikely to take a significant dent out of the $70 billion in revenue that Apple does in China. But China is, of course, one of the few bright spots in growth that Apple has right now. And if there is a push to support more Chinese manufacturers, a sort of nationalist push that we saw 6 or 7 years ago, well, 6 or 7 years ago, that created a $20 billion decline in revenue over a number of years. So if that is going to be the case this time around, that is something that Apple shareholders need to worry about. We don't yet fully know that that's the case, but it does seem to be possibly heading in that direction.
Alex, if you knew everything that had gone on with the fundamentals for Apple this year, the tension in China, would you have guessed that the stock was up by more than 50%?
I mean, look, Apple somehow, it manages to keep charging on. It has, huge free cash flow every year. Sometimes it seems they don't even know how to spend it. They can't return it to shareholders fast enough. They can't invest it in new products fast enough. So never bet against, well, I don't want to say it's foolish. It can be seen as foolish to bet against Apple because somehow they seem to manage to pull it out the hat. But this is possibly a major headwind.
It would have hurt this year, that's for sure. Alex, appreciate the update. Alex Webb there on Apple. The stock is down by about 1% this morning, still higher year to date by something like 50%. Let's turn to retail. VF Corp working to bring parts of its IT system back online after it detected a cyber disruption. Katie Greifeld on top of this story. Hey, Katie.
Hey, John. Yeah, VF Corp disclosing in a filing today that a cyber attack is disrupting its ability to fulfill its orders. Specifically, quote, unauthorized actors were detected on a portion of the company's information technology system on last Wednesday, December 13th, and that this, quote, threat actor also stole personal and other data. Now, this is an ongoing matter. VF Corp has yet to determine the full scope of the incident and is working with external cybersecurity experts and has shut down some of its systems. Now, while its retail stores are still open, customers can still place online orders. Fulfillment has been affected, and as a result, the disruption has caused and is, quote, reasonably likely to continue to have a material impact on VF Corp's operations. That, again, according to today's filing, shares off about 7.5% as a result, adding to an already difficult 2023 for this company. All told, VF Corp down by more than 30% in 2023.
Katie, thank you. Dan Hard in the early part of trading, 6 or 7 minutes into the session. Katie Greifeld there on the latest for VF Corp. Here's the latest in this market right now. So we're about 6 or 7 minutes into the session. On record high watch on the S&P 500. Katie went through the numbers a little bit earlier, positive by 0.3%. I started the program by asking, are there any bears left, particularly after what we heard from Mike Wilson and Morgan Stanley, calling it a bullish outcome for stocks, what we've seen in the last week. Think about being bullish a month ago, the middle of November, what being bullish looked like, something like 4,700 on the S&P 500, just a bit of upside. We've left all of that behind now, added more weight to this rally, and the likes of Goldman Sachs and David Kostin have had to hike the price target for next year, a price target that was only about a month old. Middle of November, 4,700. Going into the back end of December, the new price target is 5,100 for year-end next year. Right now on the S&P, 47.33. State Street's Laurie Heinel looking ahead to next year, writing this: as we head into 2024, we anticipate uncertainty to persist. It will likely be a year in flux, with many factors pressuring the path to global recovery. Laurie, I'm pleased to say, joins us right now. Laurie, refreshing just to really lean into uncertainty and not just say 5,100, 5,200 on the S&P. Why aren't you joining in with that crowd, Laurie? What's holding you back?
Well, there are a couple of things that we're concerned about for 2024. First and foremost, valuations have really gotten stretched here. So to envisage equities continue to go higher and higher from here seems a little bit naive from our vantage point. The second thing is that we do see the economy slowing. Here in the U.S., for example, we think growth is going to be somewhere closer to 2%, which hardly justifies the kind of levels that we see right now in stocks. And then lastly, we actually see better opportunities in fixed income. Obviously, we've had a massive rally from the 5% handle on the 10-year, but we think even near 4% yields, 10-year treasuries look pretty attractive.
Laurie, just going through your fixed income calls of the last month or so, I had written down that you're looking for lower rates, steeper curves, and wider credit spreads. Is that still correct? And is that the recession trade you're looking for next year?
Well, it certainly is still correct, and it doesn't have to be a recession that drives that. We think there's still a pretty good chance that we achieve a soft landing. Certainly, we haven't seen all of the effects of the interest rate hikes here in the U.S. filter through the economy, but there has been an incredible amount of resiliency. So our core view is that against a backdrop where we think growth is about 2%, inflation comes down below 3% by end of year-end, you actually do see a pretty meaningful movement in rates. And against that backdrop, we still think that credit is a little bit dicey because, of course, anything that slows the economy potentially jeopardizes those credit returns.
Credit spreads are 336 basis points, high yield spreads. I think we're literally at the tights of the year, maybe just off them by a whisker, by a hair. Laurie, what's driving credit spreads this much tighter going into an economy that a lot of people acknowledge, even if they are bullish on equities, it's an economy that's going to slow?
Well, there are a couple things. Certainly, there still is a yield pickup. So to the degree that you're looking for something more than 3 or 4%, you can get that in high yield bonds. And as you note, equities doing better in here actually helps provide a little bit of cushion, if you will, against those companies. But we're not a buyer here. We actually think that there is vulnerability, and particularly, as you say, being at the tights on spreads at a time when we've also seen rally in rates, that to us is a very toxic cocktail.
One thing that has developed in the equity market is improving breadth. It's been a big topic of conversation on Wall Street on this program as well. The banks have started to perform, the small caps have started to do well, the laggards are starting to pick up. We're starting to see increased participation. Laurie, do you see reason to believe that can continue, given your broader macro call into next year?
Well, we certainly do, but here again, part of the question is how big of an impact does that actually make? So we do expect broader broadening out of the markets as you start to see other parts participate in here, and you start to see money sort of flow into more quality trades, into places where there's been a little bit more valuation sensitivity. But again, that really doesn't destabilize our overarching view that equities could be a very dicey place to navigate in 2024.
Is it bonds over stocks for you then?
It still is, and again, I would have had higher conviction, 45 or 60 days ago, but we still do think that there's plenty of good room for bonds to run, and 4% coupon, risk-adjusted return looks pretty good in bonds.
What's the data point you're focused on right now, Laurie? Because a lot of things on the surface look pretty decent. Unemployment close to 4, GDP still holding in there. What are you focused on?
Well, the biggest thing we're going to be focused on in the aggregate is going to be earnings in 2024, because there are going to be a lot of pressures on equities, including refinancing risk as we head into the back end of 2024. Certainly inflation, while we think it's more or less run its course, there's going to be still pockets of inflationary pressures, and you're going to still see some of the wage increases that accumulated over the course of 24 sort of feed into that. So earnings is going to be one of the big things that we'll have our eye on in 2024.
Laurie, thank you for the input this morning and through the whole of 2023. Appreciate it. Looking forward to covering in 2024 with you in just a month or so's time. Laurie Heinel there of State Street on the latest. We're about 11 or 12 minutes into the session. Equities holding up by, let's call it 0.25% on the S&P, up by 0.2% on the NASDAQ this morning. Coming up on this program, BP pausing Red Sea shipments after an escalation in attacks by Houthi militants.
8% of global LNG, about 9% of global oil and petroleum products. So an enormous amount of energy that goes into the world goes through the Red Sea.
Some big moves in the commodity market off the back of these moves. That conversation up next.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power.
Balance of Power. Live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
I'm a conservative, but I'm not in a bad mood about it.
Fellow governors. Bad mood about being conservative? Is that because you feel like populism has taken control of your party?
And Joe Matthew.
What is it about race that bothers you about the new chairman of the Joint Chiefs?
Our military is becoming so political that we're going to go south when it comes to readiness.
Alongside Kaylee Lyons.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience would get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
I'm willing to have this battle. It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg. Context changes everything.
% of global LNG, about 9% of global oil and petroleum products. So an enormous amount of energy that goes into the world goes through the Red Sea. The Houthis seem to be doing something that's fundamentally and conceptually similar to U.S. secondary sanctions. Initially, they started targeting anything with nexus to Israel, Israeli ownership or management of the shipping company or the tanker, or for that matter, just cargoes going into or out of Israel. They've cast the net even more broadly now.
That was Kevin Burke of Clearview Energy weighing in on a developing story. BP announcing a halt on all shipments through the Red Sea following a series of escalating attacks by Houthi militants. The oil giant saying this: "We will keep this precautionary pause under ongoing review, subject to circumstances as they evolve in the region." Rerouting means bypassing the Suez Canal, adding thousands of miles to scheduled cargo deliveries. Let's get to the team coverage. Kelly Lyons in DC, Simon Casey here in New York. Simon, let's start with you. Developing story. What are you learning so far?
Well, as you said, John, I mean, we've had BP come out this morning. This situation is escalating very quickly. At the end of last week, we had some tanker operators saying they were really concerned about events. Now it seems like we're on the way to maybe perhaps all tanker traffic beginning to be paused from shipping through what is arguably one of the world's most important routes for energy.
Simon, have they been attacked, or are they worried about being attacked in the future?
There are attacks. They're obviously concerned about what could happen in the future. So far, I think it's fair to say the global shipping industry is quite lucky. I mean, touch wood, we have not seen a major incident where a tanker has been seriously damaged, has been loss of life, or a tanker has been sunk. But today, for example, we had a Norwegian-owned vessel that was attacked. As far as we can tell, it had no connection to Israel. So the idea that the Houthis are just targeting shipping that's destined for Israel or has some kind of Israeli connection, like it's owned, for example, by an Israeli company, that doesn't seem necessarily to hold in this case. It seems to be increasingly indiscriminate.
Kayleigh, these skirmishes haven't been isolated to shipping companies. The US military has also faced some risk around this story as well. What's the official response from authorities this morning, Kayleigh?
Well, this is something they're actively looking at, John. The Defense Secretary, Lloyd Austin, is actually in Israel now, along with the chair of the Joint Chiefs, C.Q. Brown, in part trying to advise Israel on how to lighten up in Gaza in terms of their efforts there. But the other effort really is on preventing this from becoming a wider regional conflict, because you are exactly right, John. It is not just commercial vessels that are potentially in the line of fire here. It is U.S. military aircraft as well. There are 19 U.S. warships in this region, 7 of them in the Eastern Mediterranean, another 12 across the Red Sea, Arabian Sea, and Persian Gulf. And they have had to actively engage just in recent days in shooting down drones, for example. So this is something the U.S. military is very carefully watching. The issue is, John, according to our reporting, the U.S. really can't go this alone. They are trying to make this a multinational effort, and the Arab allies, the Saudis and the Emiratis specifically, we understand, want to approach the Houthi rebel issue differently, and that is really a hiccup here in terms of getting a multi-country effort together to combat these threats. In the meantime, according to Bloomberg's reporting citing U.S. officials, the U.S. is trying to communicate directly with the Houthis via intermediaries like Oman and others, telling them to stop these attacks. John.
Simon, there is reaction in the commodity market. Let's discuss it if we can. Brent crude is up by 3.5%, close to 80 at 79. WTI is back in the 70s, close to 74, also higher by something like 3.5%. Simon, how are you and the team thinking about how this spills over, what the consequences are to the broader commodity market?
Well, one thing we're looking at as well is natural gas prices. Natural gas prices in Europe this morning jumped up even further than the increase we saw in crude oil. There's real concern there. This is a crucial energy route, as I said, and it's not just for crude oil, it's for LNG. LNG imports into Europe, and also shipments and tankers traversing the other way, heading to Asia as well. So there's real disruption there. We're talking about something like, I think as Kevin Book said earlier, 9% of global LNG supplies go through that route. You can still send tankers between Europe and Asia and from north, around the world, but they have to go around Africa. Of course, it's a much longer voyage, adds significantly to costs. It's very disruptive. So this is very inflationary all around.
Really important developing story we'll stay on top of. Simon, thank you. Simon alongside Kelly there on the latest from BP a little bit earlier this morning. Let's turn back to the equity market. About 20 minutes into the session, equities positive here by 0.3% on the S&P. On the Nasdaq up by something like 0.15 on the Nasdaq 100. Let's lift the lid on the index and get you some sector price action. Here's Simone Folksman.
Hey, John, yeah, this continuation of those 7 positive weeks for the S&P 500 that we have seen. And for a long time, it looked like this prospect of this Fed pivot had been lifting all boats except energy, that is obviously not the case today, with energy names up over 2%. Major shipping lines, including BP, Maersk, MSC, all suspending transit through the Red Sea, as you were just talking about, on these potential Houthi attacks that they have seen over the last couple of weeks, and lack of knowledge about how to exactly deal with this. We are seeing some names in the energy sector: Baker Hughes, Halliburton, Marathon Oil, really leading the gains today. All of those names up 3%, and virtually every member of this energy index higher today. But overall, you still kind of step back here and you look at an energy sector that has failed to keep pace with the broader market. On the month before today, it was the only sector down month to date. That is no longer the case. For the quarter, it is the only sector down this quarter, over 6%. That is setting us up for the biggest quarterly decline since the third quarter of 2020. And it is the second biggest sector laggard this year, second only to utilities.
It just hasn't participated. Simone, thank you. Thank you for bringing that up, because I think it's so important. Since the end of October, looking at energy names on the S&P 500, they're just about flat. On the S&P, we've seen double-digit percentage point gains on the S&P 500 over that period. If you look elsewhere, look at the financials, the banks on the S&P 500 up by more than 20% over the same period. Just massive underperformance on energy, outperformance today. Top of the pile, that group of stocks on the S&P 500 advancing by something like 2.2%. Coming up, we'll get you to the trading diary, the guidebook, the playbook through the rest of this week to try and get you through the week into the weekend and onto Christmas and the holidays. From New York City, that's next. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic, because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Looks like it's going to end up being a very substantial reduction in inflation without a big increase in the unemployment rate. That's the golden path that I talked about. But we're still above the target. We got to get inflation down to target before until we're convinced that we're on path to that. It's an overstatement to be counting the chickens.
That's the pushback from the Federal Reserve. This market ain't listening. This market's still rallying. 25 minutes into the session on the S&P 500, up by 0.25%. Can you put the toothpaste back into the tube? Neil Dutta of Renaissance Macro saying you can't. The comments from Chairman Powell on Wednesday, the headline, everything else just a footnote that no one's reading. That's the price action this morning. Let's get to the trading diary. A week ahead looks like this. Tuesday, the BOJ's rate decision just around the corner, plus FedEx reports earnings after the closing bell. On to Thursday, we'll get US GDP and another round of jobless claims, followed by quarterly results from Nike and Carnival Cruise Lines. From New York City, that does it for me, at least for this morning. I'll see you tomorrow. Thank you very much for choosing Bloomberg TV. This was the countdown to the open. Good luck for the rest of the trading day. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We're like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong? Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
right, good Monday morning from the Bloomberg Interactive Broker Studio. Jess Minton sitting in for Matt Miller. Good morning.
Good morning. Happy Monday, Paul.
Absolutely. Coming up, we're going to talk to Dan Ives, Senior Equity Analyst at Wedbush Securities. Really a timely discussion here. We have some news out today that Apple will be halting some sales of their watches in the U.S. For some period of time. So we'll break that down. That's just coming across the tape and what it means for Apple. The stock's trading off just a little bit here. And then we're going to check in with Brooke Sutherland, columnist for Bloomberg Opinion, talk about this Nippon Steel acquisition of U.S. Steel and what it means for the U.S. steel market and the global steel market. And then Lydia Boussour, senior economist at EY Parthenon, joins us to discuss recent Fed speak, pushing back on rate cuts. So a busy hour coming up, and we will kick it all off there. But right now, let's go to Nathan Hager for World and National News.
Since y'all mentioned them, Paul, we'll look at Apple shares right now. They're down 1.3%. U.S. Steel is up 26%, adding to the broader market positivity. We just got new data on U.S. home builder sentiment. It improved for the first time in 5 months. The National Association of Home Builders Wells Fargo gauge is up 3 points to 37. Falling mortgage rates are leading to a pickup in prospective buyer traffic and sales expectations. That could be adding some to some of the broader market sentiment that we're seeing here. But investors are still weighing whether the Fed and Chairman Powell are signaling a pivot in the policy framework. Dennis Gardman, former publisher of the Gardman Letter, says it depends on your definition of what a pivot is.
The pivot means lower rates immediately. No, it's not a pivot. If a pivot means the ability to hold rates steady at the overnight Fed funds rate for a protracted period of time before they cut rates, that's what we're going to have. It'll be a long period of time before the Fed, in my mind, actually pivots and cuts rates. I think it'll be late in 2024 before they actually begin the process of easing monetary policy and cutting the overnight Fed funds rate.
But for now, stocks are moving higher. The S&P is pointing to an 8th straight week of gains. In fact, we check the markets all day long on Bloomberg. Right now, the S&P is up 0.4%, up 18 points. 4737 is the S&P level. Dow Jones Industrial Average is up 27 points. That's a gain of nearly 1/10%, 37,331. The NASDAQ Composite up 0.4%, or 53 points, trading at 14,867. The 10-year Treasury is down 13 seconds, yield 3.95%. NYMEX crude is surging up 3.9%, with BP temporarily halting oil shipments through the Red Sea, putting more of a focus on supply constraints potentially. NYMEX crude is trading at $74.19 per barrel. COMEX gold is up 0.1% at $2,037.80 per ounce. The euro 1.0927 against the dollar. The yen is at 142.95. That's a Bloomberg Business Flash. Bloomberg Markets is on with Paul Sweeney and Jess Menton.
All right, Nathan Hager, thank you so much. We appreciate that. Jess Menton and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well, so you can go over to youtube.com and search Bloomberg Radio. The news, I saw that Apple News, the stock's off 1.3%, so that's interesting for those who use the Apple Watch. I don't. I actually use a real watch. But
and that stock had been trading at records, up 50% year to date, just to put some context in there.
Yep. So we got the S&P up about almost 0.4%. Let's check in with Bailey Lipschultz. He switches seats to go from the co-host seat over to the market seat.
I didn't kick him off.
And it's unbelievable. So we'll see what he's got for us.
Sorry.
I am an Apple Watch user, though, I will say. But I have
noticed.
Does
it tell time?
It tells time.
Okay, good.
As my friends and I call it, it's a $400 watch that tells you the time, and you can easily set timers. Other than that, I have no idea what I use it for.
Sorry, we have Dan Ives coming up. He can break
can
down more of
He'll
this.
break it down, but as you mentioned, Apple shares ticker AAPL down 1.3%. This coming after that 9 to 5 Mac report that they would halt sales of some Apple Watch models here in the U.S., halting sales of the Apple Watch Series 9 and Ultra 2 models, that coming after pushback from an ITC ruling that was part of a long-running patent dispute over its blood oxygen sensor technology. So hopefully Dan can give you more details on what that means for the company. But as Jess mentioned, when you're rallying, it's easy to find reasons to sell off some of these stocks. But the deal news of the day, which I know you guys are going to be talking to Brooke about, U.S. Steel getting acquired, or agreeing to a deal to be acquired by Nippon for $14.1 billion, ticker X, up 26% so far this morning. As we've been talking about, this is coming at a sharply higher premium from what Cleveland Cliffs had been talking about, ticker on cliffs is CLF. That stock was up more than 7% this morning, still up 7.7%. So seeing a rally in that company as well as Nucor, ticker NUE, as we see investors bid up some of the steel making stocks. Joe Doe did tell us maybe not to read too much into that, but nonetheless, we're seeing that group trade higher. Another stock
also, when I see an M&A trade, I go to MAGO to see what bankers are getting paid. Citigroup is acting as financial advisor to Nippon Steel, while Barclays, Goldman Sachs, and Evercore are advising U.S. Steel.
Can we address that Barclays, a British bank, is the number one lead left for the U.S. company?
Is that right? Oh, that's good. Well, that's good for them.
Yeah. So, I mean, small victories. One deal that is not getting done is Adobe's deal, ticker ADBE. They're planning to acquire Figma in $20 billion. That deal is now terminated, this coming after pushback from the European Commission and the UK's Competition and Markets Authority. So their regulatory agencies pushing back on this deal. $20 billion deal is off. Adobe will pay a $1 billion termination fee, guys. Company did have $7.8 billion in cash, so not a company that's necessarily hurting for money, but interesting enough to see them kind of take that kind of lump, if you will. Stock, though, did reverse some of those initial losses to trade higher. Just want to call out the worst performer on the S&P 500, VF Corp, parent company of North Face. You guys know I'm a big Vans guy.
So VF owns Vans?
VF owns Vans and North Face. Everyone wants to talk North Face. I think it's the Northeast bias versus the California bias.
My son was with me this weekend, and he goes to school out in California. So what did he wear this weekend? Vans. He got his Vans.
Bailey's from Cali.
I'm from California, but I will say, I looked at the Vans website. They're like $70 now. Back in the day, they used to be $40. Like no more than $40 for a pair of shoes.
But I mean, they're not as prevalent here as they are on the West Coast, right?
Not even close. I mean, when I go, I will be landing in San Diego Thursday early morning.
I think you'll be landing.
Hopefully. Knock on wood. Last
Godspeed.
time I was part of that Southwest snafu last time. And it was like
and you know
nightmare.
what? We interviewed Bob Jordan last week. Yes. Shout out to Eric Malo, one of our star producers, booking that interview. Deserves all the credit there.
Great conversation. I know Tom Keene really enjoyed that. But yeah, no, VF Corp hurt by a cyber attack, so that hitting the company. This again, hacks hitting Clorox, Boeing, among others, and that's why you're seeing that stock down 8.6%. Ticker is VFC.
So do you have Vans? So you have the shoes.
Shoes, yes.
And do we do the shirts and the shorts and the whole 9 yards?
Yes and no. I think their shirts are pretty solid. The shorts, I'm not really. You know, you hit the, like, I'm 30 now. So how much can I wear things that I wore when I was 18? Like Vans shoes, I think I can get away with.
I think you can do that.
I get nervous on like the graphic T-shirts. I feel like I'm like an imposter, and I'm that older guy at the bar who's like drinking PBR.
No, you're good. No, I feel like you could still rock it, Bailey.
All right, the hipster Bailey Lipschultz covering all the.
Matt Miller does think Bailey's from Brooklyn, even though he is not.
Southern California, through and through.
Exactly. All right, Bailey, thanks so much for joining us. Perfect time to check in with Dan Ives, Senior Equity Analyst at Wedbush Securities. He covers all things technology. Hey, Dan, let's start with the Apple news that just came across the tape here, a little bit delaying or halting temporarily, at least, some of their watch sales in the U.S. What do you make of this news? Again, the stock's off about 1.3% today.
Yeah, I mean, look, there have been some issues on the Apple Watch side, and a lot of it is really around models in terms of what they're trying to drive. I view this as just a small bump in the road, but I actually think watch sales this holiday season are going to be up double digits. So I view this as sort of noise relative to the broader story.
And I was informed that you are at the airport, so for our YouTube audience, unfortunately can't see Dan right now, but usually he's got the pastels on. Paul knows what I'm talking about.
Yeah,
but
he needs some help on that.
So we're disappointed there. But when you have a stock like this, obviously back around that $3 trillion market cap threshold, trading around records in news like this, kind of break down to us, does it make sense to you? Because you'd think, I mean, the stock's only down, I think, a little more than 1% at this point. Is it just kind of a reason to sell a little bit here?
Yeah, and just in my opinion, this is the start of the next phase of the Apple growth story. Because essentially what's happening now is services is upticking, despite some of the news coming out of China. I saw Bloomberg report it, which is obviously overall headwind. China is actually resilient as overall demand. So when you put it together, I think a year from now, still in pastels. I think we're looking at a $4 trillion market cap.
So, Dan, give us, I don't know, your latest thinking on just China in general, because arguably there is no company in the world that is more exposed positively and potentially negatively to China, both as a customer and as a source of product. How do you break that down for your clients?
Yeah, look, I think, and someone like myself spends so much time in the region, you got to separate between headline risk and what's really happening in the market. I think Huawei and what we've seen in terms of cold tech war between U.S. and China, yeah, it's an issue. But there's 100 million iPhones in China that haven't upgraded in 3 years. So the demand continues to be strong there. And I think when it comes from a production perspective, they'll diversify some into India. But the reality is next 2-3 years, I mean, that's not going to significantly change. That is the hearts and lungs of the Apple story, supply and demand.
And Dan, we know you're arguably the biggest bull on Wall Street when it comes to technology, but what do you think is the biggest risk to your bull case in the shorter term here?
Look, I think the biggest risk near term is China. It's not the numbers. It's not Fed, despite the poker game. You know, everyone knows you're going to have cuts in 24. That, I think, creates really this Pillsbury Doughboy soft landing. I think it's really the China story. It's the geopolitical, but that's also why a lot of the bears that have been in hibernation mode through all of 2023, they're starting to come out of their caves a little and look at this market, because I believe it's the start of this new tech bull market.
Hey, Dan, I guess AI, as we think back to 2023, AI was certainly a theme, certainly the tech theme. As we look forward to 2024, is there something else out there? What's the theme for 2024 in your mind?
Yeah, Paul, I think it's really use cases, because if you follow the breadcrumbs, follow the use cases, you'll find the treasure. So the use cases are really what's going to drive the next leg of growth for Microsoft, for Google, for what we see with the godfather of AI, NVIDIA and Jensen. And then you have some of the pure plays like Palantir, MongoDB, and others. And I think it's actually, a year from now, it's going to be the rest of tech. The rest of tech joins this party. I still view it from a tech party. It's 9:30 p.m. It's not 2 a.m.
Ooh. So walk us through Tesla. You had a note that came out at the end of last week talking about how Tesla battled with unions in Scandinavia, now on the radar for the street. You do have a 12-month price target around $310. Currently trading for Tesla right now, it stock's around $257. Walk us through what you're seeing with Tesla here and what you see moving forward.
Yeah, I mean, look, I think when you look at deliveries, feel de-risked for Q4. I think we're seeing a good China number. And I think that's something, there's a stock that's going to probably move higher in the next few weeks going to deliveries in early January. Now, look, with the union issue, it's a UFC battle, a WWE. I mean, they're starting to see it now in Scandinavia. It was Sweden originally. Now it's gone to Norway, Finland, Denmark. The worry here, you give in here, then UAW, Sean Fain, they watch this carefully. So you can't give an inch, you give a mile. And I think that's why this battle is so important, because I think there's better chance of me playing NFL playoffs than Tesla having union workers.
Wow.
Yes, that's right. Hey, so Dan, one of the things I'm trying to wrap my head around is, again, AI. I guess I'm there. I was, a little bit, I don't know, just cautious, skeptical at the beginning. I guess what would help me get a little bit more on board is I can go back and look at the IDC technology spend over the last number of years. How much of that going forward incrementally will be AI versus, I don't know, just tech spending growth in general?
Sure, it's a great question. I think actually it's a phenomenal question because it hits the crux here. In 2023, we think less than 1% of budgets were AI. 24, based on our analysis, 8 to 10% of IT budgets will be AI driven. Wow. That's why it's the lotto ticket for those companies with the use cases, software, chips, services, that go into that market. And I think it's all use case driven. 80 use cases today. 3-4 months ago, you had less than 20.
We've talked so much, and especially analysts on Wall Street, about the productivity boom potentially when it comes to AI. Walk us through what you think AI skills are and how employees can acquire them.
Well, I was at a conference speaking a few weeks ago, and it was more of an accounting conference. And, there, my suggestion is, for anyone on the account, it's really going to be developer language, whether it's Python or other. I think you're going to see more and more from a developer language perspective starting early, that you're going to see more start and take that over as another skill set. Because if you understand AI in the developer language, as more of these functional areas, finance, marketing, within hospitals, within healthcare, it's going to just from a skill set perspective make you that much more valuable.
Do you think it's not necessarily then just the stereotypical STEM type careers? It can go beyond that.
I think it goes way beyond that. And that's why I just disagree with the view, the whole it takes away everyone's jobs. Because I think at the next 3 to 5 years, it's a job creator when you actually start to look at what's going to happen from the developer's perspective, marketing and use cases. And I think that's why it's so important. It's something we'll be talking about for really the next decade.
All right, Dan Ives, thank you so much. We appreciate that. As always, Dan Ives, he's a managing director, senior equity analyst, Wedbush Securities, and a huge Penn State fan. He may be going down to Atlanta as Penn State football, the Nittany Lions continue preparations for their December 30th Peach Bowl date with Ole Miss in Atlanta.
I bet we see a picture on
I bet you see him on social media. Yep. Yeah, he'll be out there on the field. We'll figure that out. So, again, it's a little bit of news out there on Apple today about a temporary halt of certain watches starting in a few days in the U.S. Stock off a little more than 1% maybe on that news. Dan Ives' takeaway was not material to the overall story at Apple, and that doesn't change his outlook, which remains a very bullish outlook on Apple. He's been bullish. He's been right. We're going to have more coming up. This is Bloomberg. Let's get some company news right now. Lisa Mateo.
You got it, Paul. Japan's Nippon Steel has agreed to buy United States Steel for $14.1 billion in cash. Bloomberg's Simone Foxman says U.S. Steel has been the talk of the U.S. metals market since August.
It received some bids from the likes of Cleveland Cliffs, from S-Mark. Those bids were around $7.25 to $7.8 billion. None of them panned out, but the company did go forward with a strategic review, and apparently that was a smart move.
Now, U.S. Steel is up 26%. Apparel and footwear maker VF Corp is working to bring parts of its IT system back online after it detected a so-called cyber attack. Now, the North Face, Timberland, and Vans parent says that the hack is affecting its ability to fulfill its orders. Bloomberg's Katie Greifeld has more.
This is an ongoing matter. VF Corp has yet to determine the full scope of the incident and is working with external cybersecurity experts and has shut down some of its systems. Now, while its retail stores are still open, customers can still place online orders. Fulfillment has been affected.
VF Corp right now down about 8%. To the obesity drug market, where shares of Structure Therapeutics, well, they're taking a beating after trial results showed that experimental weight loss pill wasn't as effective as a similar product being developed by Eli Lilly. The company says its GLP-1 drug was well tolerated over the 12 weeks of the study with no serious side effects. And after 8 weeks, patients lost more than 4.5% of their body weight. Now, Structure's pill is taken once a day. Structure Therapeutics right now, it's down about 49%. Eli Lilly up about 1%. Those are the stories we're following. I'm Lisa Mateo.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Coming up to 10:22 on Wall Street, I'm Nathan Hager. We check the markets all day long here on Bloomberg, and stocks are holding on to gains, even with some of the pushback we're hearing from some Fed officials about interest rate cuts coming early next year. They're saying maybe not so fast. We check the markets all day long here on Bloomberg. Right now, the S&P 500 is up 16 points, or about 0.4%. The Dow Jones Industrial Average is up 3 points. That's a little change to the upside. The NASDAQ is up 56 points, a gain of 0.4%. 10-year Treasuries down 13 seconds, yield 3.95%. 8 of the 11 main industry groups on the S&P 500 are in the green, led highest by communication services and energy. Right now, NYMEX crude is up 3.2% at $73.69 per barrel, with BP halting shipments through the Red Sea. COMEX gold is little changed at $2,035.70 per ounce. The euro 1.0925 against the dollar. The yen is at 142.97. We continue to watch U.S. steel up more than 26%, with Japan's Nippon Steel buying the American stalwart for $14.1 billion in cash. That's a Bloomberg Business Flash. Bloomberg Markets continues now with Paul Sweeney and Jess Menton.
Nathan Hager, thank you so much. We're going to pick up right where Nathan left off. Jess Met and Paul Sweeney live here in our Bloomberg Interactive Broker studio. We're streaming live on YouTube as well, so go over there and search Bloomberg Radio. We want to pick up, again, right where Nathan left off there, Nippon agreeing to buy U.S. Steel for $14.1 billion, the deal of the day. Brooke Sutherland joins us. She's a columnist covering all these industrial companies and deals, so a great voice to get on that. She's from Bloomberg Opinion, zooming in from Boston. Hey, Brooke, what do you make of this deal? I mean, it kind of feels like I'm trying to wrap my head around the valuation. The last time I had paid attention, Cleveland Cliffs had a $7 billion offer on the table, and now $14 billion. Where did that come from?
It is certainly a very robust premium. I mean, I think that underscores the value of these assets, especially in the context of the sheer amount of investment we're seeing in the U.S. in infrastructure and also in factory construction. You need steel to make all of those things. U.S. Steel has also been pivoting toward greener production strategies. All of that is very valuable, and these are scarce assets. There's not that many big steel companies left to purchase, and for Nippon, the ability to gain a really strong foothold in the U.S., I think, is what's really driving this premium here. But it's certainly a significant step up from what we were talking about in August when Cleveland Cliffs lobbed in its initial bid. And I think that's why you see Cleveland Cliffs out this morning congratulating U.S. Steel on this deal and wishing them luck. I think that economic gulf is just far too wide for them to be able to close.
If you look at U.S. Steel stock, ticker symbol X, up about 26%, on pace for its best day since August 14th of earlier this year. You look at Nippon, it's actually down about close to 5%. So is it fair to say, if you are a U.S. Steel shareholder, that they're liking this deal?
I mean, sure. I don't know what there is to not like about this deal if you're a U.S. Steel shareholder. It's normal for, stocks of the acquirers to go down on the announcement. I mean, I think the biggest question as a U.S. Steel shareholder is what the U.S. government is going to think of this deal. On the call today to talk about it, executives said they did not foresee any issues from a CFIUS perspective, although, of course, this will get a review with a foreign company buying a U.S. one. I think that it might be slightly more complicated than their answers on the call suggested. This is a very politically charged industry. It was not that long ago that we were slapping tariffs on steel imported from Japan as a quote-unquote national security issue. And so I think this is going to get a lot of scrutiny. We already had some comments from politicians, back in August when this kind of first came under, the prospect of a deal was being talked about. The number of politicians said, we do not want to see U.S. Steel sold to a foreign company. And obviously that is the announcement that we're getting today. And so it's going to be interesting to see what happens with this. Now, I will say, I mean, there's been a number of foreign companies making investments in the U.S. spurred by the incentives included in the CHIPS Act, included in the IRA. Those have been cheered by the Biden administration. And from a practical standpoint, if jobs are being created and factories are being built, does it really matter if it's a U.S. company or a U.S. subsidiary of a company that's based in a country that's a strong U.S. ally? Maybe not, but politics can be very prickly.
How about the unions, Brooke? I know the unions are a very important voice in these deals, and I believe the union had supported the Cleveland Cliffs offer. I'm not sure about this one.
No, the head of the unions made some comments to Bloomberg News this morning in an interview that the notice on this deal was rather short, and they were not involved in the communication leading up to it. And so it will be interesting to see, what tactic the union takes if it doesn't like this deal. I don't know what avenues they have to push back at this point. They'd said they were willing to transfer their right to counterbid to Cleveland Cliffs, but as I mentioned, Cleveland Cliffs is out this morning congratulating U.S. Steel on the deal. They do not look like they are gearing up to try to challenge this offer, and the difference between what Cleveland Cliffs was offering and what Nippon is now offering is very wide, and that would be a very tough gap to bridge. So I'm not entirely sure what the union can do to block the deal at this point.
So any sort of regulatory hurdles?
Yes, like I just was talking about with CFIUS, I think that's going to be a key one to watch.
So there's nothing like, can you actually explain CFIUS to me? Because I was just going to ask about DOJ or FTC, but maybe there's a different body here. So explain the CFIUS review.
Sure. So CFIUS gets involved when there's a foreign company acquiring a U.S. asset. And so they tend to review deals from a national security perspective. So it's a different process than what we typically see from the antitrust regulators. There was some question about whether a Cleveland Cliffs U.S. Steel combination would raise antitrust red flags. I don't think that's the primary concern in this case, as Nippon does not have a particularly robust presence in the U.S. already from a steel perspective. So the question is really going to be, are we comfortable with letting a foreign company own this U.S. asset? Obviously, Japan is a very important U.S. ally. It is a very different question than if there was a Chinese company trying to come in and buy a U.S. steelmaker. But I still think, just given the environment that we are in politically and all of the scrutiny over ownership of important American assets, that this is going to get some scrutiny.
Do you foresee additional M&A happening in that particular industry group on the back of this?
Never say never. I mean, anytime you have a big deal like this, it tends to get people thinking about what other possibilities there could be. But this is already a very consolidated industry. And so I think to see much more consolidation happen would be difficult. And then you do start bumping up on questions of antitrust.
So explain to me, Brooke, I know one of the growth areas of U.S. Steel is, I think they have a new plant, maybe in Arkansas or something. Can you talk to us about that plant and that technology?
Sure. And so it's a greener technology. They use sort of more recycled materials. This is sort of considered the future of steelmaking. And so that's obviously a very attractive asset for Nippon. And these companies talked a lot about on the call about sort of their shared commitment to decarbonizing, about investing in R&D and new technologies to try to improve upon the steelmaking process. And so that's certainly one of the key drivers of this acquisition.
And when it comes to something like this, especially if you're thinking about steel and what that means for the global economy, as far as the position that these two companies are in, what do you think this tells us about the global economy if these two are potentially merging here?
Sure. I mean, I think it's a vote of confidence in the U.S. manufacturing renaissance or revitalization of U.S. supply chains, onshoring, whatever you want to call it. It's a narrative that's taken some hits recently. If you look at particularly in the EV sector, there's been a number of companies sort of pulling back or delaying some of the investments that they've announced. And, that sort of just does raise the question of, okay, well, what does this onshoring boom actually look like? And this is something that I've written about a lot, is I think that, there was a lot of enthusiasm around this, partly because of the government stimulus, but this was never going to be sort of a clear and streamlined timeline, that there's a lot of variability here, a lot of pushes and pulls. This is not something that has, managed to separate itself entirely from the broader economy, that companies are still sort of subject to those economic forces, but there are underlying tailwinds here that are driving investment. One of which, of course, is the stimulus funds. Another is, the lessons learned from COVID, but also, the tariffs under the Trump administration, that it's very valuable to have a U.S. supply chain and not be dependent on having to ship goods from across oceans. And then, the energy transition, things like that are very strong underlying forces that I think will ultimately lead to more manufacturing in the U.S. It just may not happen on the timeline that we might have been hoping for.
Brooke, thanks so much for joining us. Brooke Sutherland, columnist covering industrials and deals for Bloomberg Opinion. Again, Japan's Nippon agrees to buy U.S. Steel for $14.1 billion. And of course, I go check out who the bankers are. The M&A bankers. Citigroup is acting as financial advisor to Nippon Steel. Barclays, Goldman Sachs, and Evercore are advising U.S. Steel. So it's a good deal to get announced before year end. Two, global iconic names, particularly U.S. Steel, but Nippon Steel's been a big player globally for a long time. So, good M&A trade to get on your sheet right before year end. You go talk to your boss, but they'll be working over the holidays, papering over this deal.
They will, and then again, U.S. Steel, ticker symbol X here, up 26% on pace for its best day if it holds these gains since October 14th.
About 140%.
Yes.
From the day prior to the Cleveland Cliffs deal. So that's kind of like pre-deal talk to now. 140% is on the Bloomberg reporting. So just a huge win for shareholders. All right, right now, let's head down to Washington, D.C. We'll get world and national news with Amy Mars.
Thank you, Paula. Blockbuster storm tearing up the East Coast has already knocked out power to thousands, grounded hundreds of flights, and promises to bring flooding, rain, and dangerous winds through today. Now, Bloomberg meteorologist Rob Carolyn says the worst of it has moved out of the D.C.-Baltimore region. Eastern New York and western Massachusetts are still set to get up to 5 inches of heavy rain today, and New York City will be rattled with the worst of the storm, mostly the windy part of the storm, starting at noon. BP says it will pause all its oil tanker shipments through the Red Sea following an escalation of attacks on merchant shipping by Houthi militants. BP is just the latest company to take this action, as these attacks are prompting widespread trade disruption. We get more from Bloomberg's Oliver Crook.
With Moeller-Maersk and Hapag-Lloyd, both of the huge shipping container companies of the world, saying that they're basically telling their ships to not go through that passage at the Red Sea that passes by Yemen. And of course, you have the IDF repeatedly warning, hasn't quieted down in the north around Hezbollah. So again, all of these are still very much alive. And again, you're starting to see some of the macroeconomic consequences.
That's Bloomberg's Oliver Crook reporting. Israel is resisting growing international pressure to call a truce with Hamas. Over the weekend, the foreign secretaries of the UK and Germany wrote a joint letter to the Sunday Times urging a sustainable ceasefire. Bloomberg government's Zach Cohen has more on this now from Washington.
Defense Secretary Lloyd Austin is there. National Security Advisor Jake Sullivan, I believe, recently visited, all trying to limit the number of civilian casualties in the Gaza Strip, which has seen thousands of civilian deaths since Hamas attacked Israel on October 7th.
Bloomberg government's Zach Cohen in Washington, and Israel's foreign minister says any calls for a ceasefire with Hamas, he would be considering it as a prize for terrorism. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
Facts, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
$10:40 on Wall Street. I'm Nathan Hager. We check the markets all day long here on Bloomberg, and stocks are kicking off this week on a positive note. It's being helped by a burst of deal news. More than $40 billion of mergers and acquisitions hit the wire this morning after months of disappointing volumes. That's according to data compiled by Bloomberg. Leading the way, U.S. Steel, the icon of American industry, being purchased by Nippon Steel of Japan for $14.1 billion. And looking at U.S. Steel shares right now, they are higher by more than 26%. Stocks as a whole are higher as well. The S&P 500 is up 15 points, or about a third of 1%. The Dow Jones Industrial Average is up 13 points, little changed. The NASDAQ holding on to a 0.3% gain, up 44 points. Mira Pandit, global market strategist at JP Morgan Asset Management, says the U.S. economy is moving closer to a pre-pandemic normal. So what does that mean for this year's stock rally into next year?
I mean, we never want to hate a rally, and I feel like this rally has been causes some reluctance, except for now, because we have finally completed the trifecta of upside surprises. You saw an avoidance of a recession, and in fact, we saw a acceleration in growth. We've seen inflation come closer to the Fed's 2% target, and now the Fed has finally acknowledged not only did we pause, but we're also thinking about cuts.
And you can hear more from Mira Pandit of JP Morgan Asset Management on the Bloomberg Surveillance podcast. Looking at treasuries right now, the 10-year's down 13.30 for a yield of 3.96%. The 2-year is at 4.45. NYMEX crude is up 2 2/3% now, trading at $73.33 per barrel. COMEX gold is little changed, up $1.10 at $2,036.80 per ounce. The euro 1.0912 against the dollar. The yen is at 143.01. Just got this headline from Blue Origin, the private space company founded by Amazon founder Jeff Bezos. It says it is scrubbing today's unmanned launch of its new Shepard spacecraft due to a ground system issue. They say they'll reschedule sometime this week. That's a Bloomberg Business Flash. Bloomberg Markets continues now with Paul Sweeney and Jess Menton.
Thank you. We appreciate it. And we're going to switch things up here, talk more about the economy, Paul. And back with us is Lydia Bosor, senior economist at EY Parthenon, joining us on Zoom to chat with us about a chorus of Fed officials pushing back on the idea of rate cuts coming as soon as the spring. And she'll also share with us her outlook for the U.S. economy in 2024. And as you know, Lydia, we've had a number of Fed speakers come out since Fed Chair Jerome Powell's press conference last Wednesday. And again, we've heard from Austin Goolsbee, who currently is a voting member this year, won't be next year, but we also heard from New York Fed President John Williams, also Loretta Mester, who will be a voting member next year. And a lot of people have argued that they're kind of pushing back on these rate cut bets, but it seems like them and also Raphael Bostic have been pushed, actually more so potentially agreeing with what Fed Chair Powell had actually said, because it's this idea of they're trying to signal more so potential rate cuts in the second half of next year, right? Not necessarily as soon as the spring.
Yes, that's right. Good morning. So we've heard a number of Fed officials coming out and essentially kind of pushing back against that dovishness that we got at the Fed meeting. I think it's a little bit difficult to walk back, that dovishness, given that it really surprised, market participants. We've seen a lot of rate cuts being priced in for next year. Now, when it comes to our view, it didn't really dramatically change what we think will happen next year. We have a fairly soft inflation outlook for next year, with a lot of disinflation happening and the core PC inflation drifting below 2.5% early next year. So we have a first rate cut happening in May and about 100 basis points of rate cuts happening next year. And we think that, initially we thought that this discussion would start unfolding early next year. But what we heard is that this has already started and that the Fed essentially already started setting the stage for that policy recalibration to happen next year.
So you think you're probably, I guess, on the more dovish side, you think rate cuts, in fact, will happen and will happen perhaps sooner than maybe some of the hawks are suggesting?
Yes, we were on that side of expectations. Our view essentially is that there are a lot of these inflationary forces currently in the economy, and that a lot of people have been talking about that last inflation mile being, going to be quite difficult, and we think that that's not necessarily going to be the case. We have an economy that has slowed, and that will slow, we think, more in the first half of next year. We do not expect a recession, but we see a slowdown in growth below trend. We also expect more rebalancing in the labor market and more moderation in wage growth. And then you have that disinflation on the housing front in the pipeline that should help with core services inflation. So, by the end of next year, we do think that, both headline and core inflation are going to be closer to the 2% target, still slightly above it, but we're gonna make more progress on the inflation front.
We have more data coming up this week, even though people may not realize it and feel like it might be slower just given the last couple of weeks of the year here. But we'll have, when it comes to consumer spending, we'll also have PCE, as you know, the Fed's preferred gauge for inflation. We'll also have another update to the third quarter GDP numbers, which already the last revision came in north of 5%. How do you view some of this data coming up? And obviously, when you think about the Atlanta Fed's GDP number for the fourth quarter, not nearly as strong as the third quarter, but coming in around 2.6%, actually revised higher last week.
Yeah, so I think one important piece of data is going to be the report on Friday for personal income and spending. And we already got, the preview from the retail sales report showing that consumers continue to spend at a decent pace with, a stronger than expected retail sales. And when we look at our tracker in terms of consumer spending growth, we do expect to see, consumer spending growth above 2%. That's going to be a downshift from the type of growth that we saw in the GDP report. So the GDP report, is going to be kind of backward looking, but still, I think the message is going to be that the economy is still carrying some positive momentum in the fourth quarter of this year. And when it comes to inflation, we're going to get that confirmation that we're making more progress. We have headline PCE inflation likely to have a 2% handle, and core inflation also showing more disinflation. So if anything, this package of data is going to show that we continue to see some encouraging dynamics and those soft landing economic dynamics that have been prevailing for some time now.
Lydia, how about the employment market? We remain surprisingly robust. We actually had the unemployment rate dip from 3.9 to 3.7%. What's your call there? Are we going to get a soft landing with a good labor market?
Well, when it comes to the labor market, the report we got, the latest jobs report, also showed, some resilience. I think it's important to take an overall picture for the labor market and really look at what we've seen over the past year. We've seen some loosening in labor market conditions. We've seen job openings coming down. We've seen the labor supply rebounding. So really some encouraging rebalancing there. I think, when you look at the composition of job growth, what was really striking over the past few months is the fact that it's been increasingly less broad-based. When you look at job growth, you had about 70% of payroll growth that was concentrated in the healthcare and government sector. So, we see some broad-based softening in job growth, and we think that this is going to continue in the coming months. You have companies that are still facing an environment where demand has slowed, and also seeing more pressure on profit margins as well. So we think that in this environment where cost is still elevated, companies are going to grow even more reluctant to hire. So we see more pain for the labor market. We don't see a broad-based retrenchment in employment, but we see the unemployment rate drifting higher towards 4.3% by the end of next year.
Okay, Lydia, thanks so much for joining us. Appreciate getting your thoughts, your analysis. Lydia Boussour, senior economist, EY Parthenon. So giving us some thoughts there. Kind of a soft landing, rate cuts. She remains dovish, and those rate cuts will happen, earlier rather than later in 2024.
Yeah, I like to look at the ECFC function. We talk a lot about that. If you want to look at the consensus estimates from economists on Wall Street in the terminal, so you can look at that as an annualized growth, or you can also look quarterly there. But when you are looking at that, even on a quarterly basis, you aren't seeing a contraction overall in growth. You see it decelerating a bit the next couple of quarters, at least. Again, this isn't Bloomberg calling it, but the consensus forecast from economists on Wall Street, Paul.
Yep, absolutely. So we keep an eye on that. S&P 500 up 0.3%. We'll have more coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
You got it, Paul. Apple shares, they are lower this morning after a report from 9 to 5 Mac that the company will halt sales of its Apple Watch Series 9 and Ultra 2 models in the U.S. Now, this follows an ITC ruling that was part of a long-running patent dispute around the device's blood oxygen sensor technology. Wedbush Securities Managing Director Dan Ives isn't too concerned.
I view this as just a small bump in the road, but I actually think watch sales this holiday season are going to be up double digits. So I view this as sort of noise relative to the broader story.
Now, devices will remain available for purchase from other outlets, including Amazon and Best Buy. But that's not all Apple has to be worried about. More government agencies and state firms in China have ordered staff not to bring iPhones to work. Bloomberg's Alex Webb says it's extended to 8 further regions.
These sales in and of themselves are unlikely to take a significant dent out of the $17 billion in revenue that Apple does in China. But China is, of course, one of the few bright spots in growth that Apple has right now. And if there is a push to support more Chinese manufacturers, a sort of nationalist push that we saw 6 or 7 years ago, well, 6 or 7 years ago, that created a $20 billion decline in revenue over a number of years.
All right, so let's check in with those Apple shares. They're down nearly 1.5%. Well, Adobe has walked away from its $20 billion acquisition of startup Figma. This is after clashing with regulators in Europe and the UK. Adobe will pay Figma a $1 billion termination fee. The deal would have been one of the largest takeovers ever of a private software maker. Adobe shares are up about 0.5%. Those are the company stories we're following. I'm Lisa Mateo.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, looking at these markets here, S&P 500 up 0.25%. The Dow Jones absolutely unchanged on the day. The Nasdaq up about 0.2% here. Looking at the yield slightly higher. Got the 10-year Treasury, let's call it 3.95%. Crude oil, it's moving higher yet again on some of those Mideast security concerns, up 2.8%, $73.50 for WTI crude oil. So we'll keep an eye on that in the energy space. Again, all eyes on some of the issues there, the geopolitical issues. Right now, let's head down to Washington, D.C. We'll get World at National News with Amy Morris.
All right, thank you, Paul. Thousands of people are without power. Hundreds of communities along the East Coast are dealing with standing water and flooding after a deluge overnight and this morning. Bloomberg meteorologist Rob Carolyn says the rain is moving on, but the winds are just getting started.
The problem will continue to be winds through the afternoon. Wind advisory in effect for southern New England through 7 p.m. this evening. We'll see some gusts in the New York City area over 30 miles an hour this afternoon. Boston, though, could see some gusts over 45 miles an hour. Washington, D.C., some breaks of sunshine through the afternoon. It will be breezy in the district in Baltimore. Some gusts over 30 miles an hour are possible.
Flood warnings and watches reach from Maine to North Carolina. The Senate is putting its holiday break on hold to try to reach a deal on Ukraine aid tied to tougher border policies. But as Bloomberg government Zach Cohen reports, the negotiations are still proving difficult on Capitol Hill.
It's not clear if the Senate will vote actually on an aid package this week. Senate Majority Leader Chuck Schumer is keeping the Senate in session for the first week of its planned 3-week recess to try to move a package forward if some sort of framework had come out of talks over the weekend.
Bloomberg government Zach Cohen in the nation's capital. A joint intelligence bulletin from the Department of Homeland Security, FBI, and the National Counterterrorism Center warns of an elevated threat of an attack targeting public gatherings through the holidays. CBS News reports the threat is likely amplified by ongoing tensions related to the conflict between Israel and Hamas. The European Union took the first formal steps against Elon Musk's X over allegedly breaking rules on how it handled illegal content and disinformation, 2 months after warning the company, formerly known as Twitter, over how it handled harmful content on its site. It is the first such probe of a major online platform since the bloc's Digital Services Act came into force this year. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg. Paul and Jess.
All right, Amy Morris, thank you so much. We appreciate that. So just more news in the weight loss pill. And this one is not good news. Weight loss pill developer plunges as results trail Lilly's. So shares of Structure Therapeutics tumbled after the company disclosed trial results showing its experimental weight loss pill wasn't as effective as a similar product being developed by Eli Lilly. The shares fell as much as 55% when New York markets opened Monday, the most intraday since they were first offered in February. They had quadrupled this year.
Right.
Wow, as of Friday's close. So the Structure's results in patients with type 2 diabetes showed less efficacy than mid-stage data on Lilly's drug. That's according to an analyst at BMO Capital Markets who said that in the note. Although those optimization could close this gap, or dose optimization could close this gap. So it's tricky business out there.
It is, and when you look at where it currently is trading, still down about 47%, so still on pace for its worst day since those shares were offered, like you were mentioning back in February there. And we've talked so much about the wild swings we've seen in some of these stocks. If you look at Eli Lilly, though, that stock year to date, LLY is the ticker symbol on this, up almost 60%. So on pace for its best year since about 2 years ago there. But obviously there's it has benefited from a number of different things when you are looking at Eli Lilly the past few years here. But when you're looking at this other stock though, when it comes to Structure Therapeutics, really getting pressured here in morning trading.
Yeah, and another one on that GLP-1 drug, the weight loss drugs, Novo Nordisk is another name that gets had a lot of success, and a lot of people are paying attention to. That stock is up 2.2% today, 46% year to date. Obviously, we've seen some sizing of this market, total market opportunity, over $100 billion, and north of that, I've seen $150 billion. So it's a massive new market,
Multi-billion-dollar business here that companies are trying to get into, especially when you're looking at obesity treatments for these blockbuster successes. But again, a reminder, it is supposed to be used for a lot of these things for diabetes.
Exactly. S&P 500 up 0.3%, NASDAQ up 0.2%. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to have a fascinating report on Boaz Weinstein, the hedge fund fella. He's out there battling BlackRock in Nuveen in a small part of the market that I'm not going to say small, but it certainly does get a lot of attention. That's the close-end fund space. He's got some issues with some of those big players, so we'll get to that story. RJ Gallo is going to join us here to break down the bond market, senior portfolio manager covering fixed income at Federated Hermes. And then the emerging market outlook. Penny Foley is going to join us. She's the managing director of emerging markets at TCW out on the West Coast. We'll get her thoughts on emerging markets in 2024. And let's kick everything off this hour like we like to do with Mr. John Tucker. No, actually, I take that back. It's going to kick it off with
Nathan Hager.
Nathan Hager, thank you.
Down in D.C., but I'll watch the markets for you. Let's get right to the numbers, shall we? We check the markets all day long here on Bloomberg. S&P 500 right now is up 13 points, a gain of 0.3%. 4732 is the S&P level. The Dow Jones Industrial Average is ever so slightly in the green, up 16 points at 37,321. The NASDAQ Composite pointing to another record today, up 28 points or 0.2% higher, 14,842. More analysts are raising their price targets for stocks next year after the Fed signaled last week it's thinking about lowering interest rates. Some Fed speakers are pouring a little cold water on the idea that those rate cuts could come early in the year. But Scott Cronert, managing director at Citigroup Global Markets, says it's tough to imagine Treasury yields going much higher from here based on what the Fed's been saying.
The playbook from here is a more benign interest rate outlook. What we think that does is provide a more stable backdrop for the market to respond to fundamentals. And there, we are quite comfortable and constructive on the earnings outlook for the S&P 500 next year.
And you can hear from Scott Cronert of Citigroup more of his thoughts on the Bloomberg Surveillance podcast. Right now, 7 of the 11 main industry groups in the S&P 500 are in the green, led highest by communication services and energy. Information technology is the biggest laggard on the S&P right now. But overall, as I said, the S&P is higher by 0.3%. 10-year Treasuries down 10/30 seconds for a yield of 3.95%. The 2-year yield is at 4.45%. NYMEX crude continues to move higher, up 2.8%, trading at $73.43 per barrel. COMEX gold is little changed, up 60 cents at $2,036.20 per ounce. The euro is at 1.0917 against the dollar. The yen is at 143.05. In Washington, House Democrats have opened an inquiry into Diversified Energy. That's the largest owner of U.S. oil and gas wells. It says the company's unusual business model of buying old, minimally productive wells and keeping them in operation as long as possible could leave taxpayers on the hook and affect global climate change as well. Diversified Energy is lower by 2% in London. That's a Bloomberg Business Flash. Bloomberg Markets continues now with Paul Sweeney and Jess Menton.
Thank you, Nathan. We appreciate it. Joining us now is one of our star reporters on our equities team, Yi-Chin Shen, who wrote a story with our cross-asset reporter, Valdana Heyrick, about Boaz Weinstein battling BlackRock Nuveen in a $240 billion crusade. Walk us through this story that you did with Valdana.
Okay, yeah, thanks. First, thanks, Jess, for having me today. So our story is about how Boaz Weinstein at Sabal Capital is ramping up his fights in the closed-end fund industry. And this is a battle against some of the largest asset managers from BlackRock to Nuveen. And Jess, I don't know how familiar you are with closed-end funds. This is usually more like a sleepy corner of the finance world, but right now they are really under under a time of crunch because these funds buy into cash-generating assets like junk bonds, muni, and dividend payouts. And with the interest rate environment right now, many of them are trading at historical wide discounts to the value of their underlying assets, say some muni funds 10 or 12% below their NAVs. So Boaz Osaba is coming in as an activist to say we need to fix these discount issues, and many of these funds are managed in a very problematic way. So too often his argument is that these asset managers only care about collecting fees and returning, maximizing value for shareholders. And as part of his campaign, he's pushing these money managers to turn these funds into an open-end structure, say mutual fund, ETF, or do tender offers so that eventually investors can cash out much easier and restore their losses from the discounts. And end of day, his argument is if his activism campaigns could succeed, then that's a win for all investors involved in these products.
All right. So, I mean, as best I can tell from your reporting, his point is these closed-end fund managers just lost a lot of money. Well, so what? That's the market. So he's saying now these funds, closed-end funds, they tend to buy income-producing assets like junk bonds, municipal debt, or dividend-paying stocks. Now, they have been clobbered by the Federal Reserve's rate hike campaign. So bond prices plunging over the last couple of years across markets, investors have looked to bail out of these closed-end funds, pushing the price down. All right, so again, these fund managers were simply wrong, and the funds are going down. And is he arguing that there's malfeasance, or is he arguing that they're just poor managers? Is he arguing that they're getting paid too much and they're losing money?
Right. His point is about there's an easy fix on these solving the discount issue is that we open some of these funds and liquidate them and return the money right back to the investors at loss. But I would say the other side of argument from BlackRock or Nuveen, their point is that closed-end funds, the discount issue is more structured issue. So it's the nature of the product. And their argument is also think about who are the usual investors. A majority of investors for closed-end funds are retirees. So they are the, think about mom and pops that relying on these products for a steady income payout, and they wanted to hold it for long term. So what these activists are doing and pushing is all just for, short-term profits for their own benefits, and that is at the expense of long-term patient shareholders.
So then what's next?
Right, yeah. So as you can see, the tension between activists versus asset managers are really building up. But I would say that Boaz and Saba is definitely doubling down in their campaign. So just this year, they launched more than 60 new activism campaigns, and now they're invested in around 150 funds. That's about 35% of the total industry. So that's a real, quite a power they're building, right? And I would say that Saba's campaigns are also getting more aggressive and more sophisticated. So now they are launching not only proxy fights, but also litigations. One thing to note is that just earlier this month, they won 2 lawsuits against a bunch of funds managed by BlackRock and Nuveen. The legal battlement was around if these funds could restrict Saba on the voting rights with their shares. So the court rulings came in favor of the activists, and I think that will open the door for them to, buy more shares, have more votes, and eventually have more sways on the board. So I would imagine going into next year, they will keep pressing on, this corner of the market, and we will see how it plays out.
He's putting his money where his mouth is. Nearly 70% of Saba's $5.6 billion in equity assets were in closed-end fund positions as of December. That's according to data compiled by Bloomberg. More than twice as much in dollar terms as the same period last year. So he's ramping up his campaign here against some of these closed-end funds. Yijin, thanks so much for joining us. Yijin Chen joins us. She covers all that stuff for Bloomberg News, joining us live here in a Bloomberg studio. You can read that article on Bloomberg.com and on the terminal as well. Let's get to the fixed income market, because believe it or not, the fixed income market is eking out some pretty solid gains to finish out the year. I see a lot of green when I look across my fixed income space after a brutal 2022. RJ Gallo, he's a senior portfolio manager covering the fixed income space at Federated Hermes. So RJ kind of started off the year, or kind of up until just recently, kind of middling returns across fixed income, but a little bit of a rally here into year end. What do you make of it?
Well, I think it was what we ultimately expected should have happened. We were very surprised, and I have to be frank, not well positioned for the sell-off that occurred, the drastic sell-off really that occurred September, October. We sort of stuck to our guns expecting an economic deceleration, an inflation deceleration, and a Fed that would acknowledge all of the above. And ultimately, that's happened even more than we expected. We thought that the 10-year Treasury might end the year, around 4.25. We're a little south of 4 right now. So the rally was fundamentally based. I think it draws into question some of the dramatic sell-off that we saw previously, but the fundamentals have moved in the bond market's direction and helped to ease fears that the Fed would have to keep tightening. Now the market's probably overpriced easing. That's the new challenge.
Hey, RJ, what is speculative positioning telling us about the potential direction of yields?
Well, I struggle sometimes. I think a lot of that futures data on speculative players, it only shows you sort of part of the picture. I think that JP Morgan puts out something, and you guys graph it on Bloomberg as the data series, the all-client net long series. And I like to watch that because I think it takes a broader look at not at just futures, but it looks across all instruments and your overall duration positioning. And it had gotten pretty long even during the sell-off, so much so that at one point a lot of the faster money crowd in the street were calling the real money crowd like us long and wrong. I even had that voiced to me on television on a Bloomberg show, which was really great. But ultimately, we held on to our long, and it was proven right. I think what's interesting now is that I heard this morning that the all-client net long survey has faded from a long position back to a little bit more neutral, which makes some sense. That's sort of where we've gone. We felt that the rally would happen. It did. We thought that bonds would give you solid, mid-single-digit total returns in 2023. It was a heck of a ride to get there, but that's what's happened. The year-to-date total return on the aggregate index is 488. If you look at the Muni index, on the S&P Muni index, it's up 5.4. Now the big question is, will the amount of easing price in the market be in a sense affirmed by an economy that keeps slowing and a Fed that needs to ease either to secure a soft landing or prevent something worse like a recession?
488 on the U.S. aggregate, positive returns, obviously, and much better than in 2022. I was surprised, RJ, that the real leader here across the fixed income space has been high yield, up 12.2%. Did that surprise you? Because it seems like everybody's been talking about a recession. If there's a recession, do I want to hold high yield credit?
I think that you're spot on. The high yield expectations, you go back 12 months, the market's consensus was a recession in 2023. Obviously did not happen. We even had a north of 5% GDP expansion in the third quarter. As a result, I think high yield was priced for caution, and then ultimately the economy gave them something else, gave them expansion. And as a result, high yield outperformed. The valuations really came in, spreads tightened a lot. These total returns are great. In retrospect, you look back and you sort of kick yourself. We obviously have a big high yield operation and very well respected in our company. In our multi-sector funds, we also own high yield, but we were a little underweight because we had some of that caution that I was just explaining. So where are we now? I think the question now is valuation and looking forward. We're still a little cautious on high yield. We've gotten more constructive on investment grade. If you get a soft landing, it probably does. It's probably wind at the back of risk assets broadly defined. That said, we still have concerns about high yield valuation and the prospect of some uptick in default risk.
Something I've been thinking about, RJ, is when we saw the 10-year briefly cross 5% back on October 19th, come down about a percentage point, as you know. At what point is there a level where yields fall too much? Are you watching a particular level in the 10-year and the 2-year to where that could signal concern about the economy? Or do you think there's still a lot of room to run there with yields coming down before that's more of a broader concern?
It's a very good question. Our view, 10s look sort of aggressively priced here. 2s a little bit as well. 2-year to me probably should be back north of 450. We're at 445, not that far. 10 years I would think should be a good bit higher than 4% for knowing what we know now. I think that the probability space assigned to a recession has shrunk, and the probability space assigned to a soft landing has grown. And that's where the market is now largely priced. I would question, if in fact we do get the soft landing, then there might be too many eases in the market. If we get the recession, there might not be enough eases in the market. So as much as the Fed likes the phrase data dependent, I think the market now is very sensitive to data as we look forward, because we're priced now for either soft landing or recession. I think soft landing gives higher probability weight than the recession does looking forward. And we have to see if the data actually verifies that. The rally last week on the Fed's pivot, which some pretty prominent Fed officials are pushing back upon a little bit these days, opens up the door for maybe a little bit of disappointment on returns in the very near term, if in fact inflation stays a little sticky, if in fact the economy has too much of a head of steam that you start thinking they can't possibly ease 5 or 6 times. So we've become very sensitive now to valuations now that the market sort of made its mind about the Fed, maybe a little prematurely.
All right, let's get to the important stuff. RJ Gallo, University of Michigan, Rose Bowl, January 1st against Alabama. How you feeling about it?
It's so funny how just about every Michigan fan doesn't understand how the ACC champion didn't make it in to the college football playoff. I had no idea that Wolverines were just so fond of Seminoles. But yeah, I think we would have rather played the Seminoles, but now we're playing the Alabama. I feel good about it. It's been a heck of a ride. The bond market was dramatic in 2023, and so was being a Michigan fan. To be undefeated and then widespread allegations of cheating, it's been a lot of up and down. But we'll take it, and hopefully we move on and have some success on January 1st and thereafter.
All right, very good. Michigan is a 1-point favorite against Alabama as of right now for those that played the game. RJ Gallo, thanks so much for joining us. RJ Gallo is the Senior Portfolio Manager at Federated Hermes, and he's a proud Michigan man, so paying attention like all those crazy Michigan fans will be against Alabama.
Texas Bowl next Wednesday, December 27th. So Texas A&M playing against Oklahoma State.
That'll be a good game.
It'll be a good game. We had
a little disappointment for the Aggies.
Kind of a interesting season, but you know what? Looking ahead to this, and then 2024. Obviously, next year it's the week after Thanksgiving, but that's when A&M plays that other school in Austin.
Right. Now you guys are joining the. You guys are already in the SEC.
Correct. We used to be in the Big 12,
right,
and we haven't played UT since it's been at least a decade.
Really?
Yeah.
So that'd be big for it.
Oh, it's going to be big. It's going to be huge.
Yeah. Okay. Very good. All right. S&P 500 pushing a little higher here, up about 0.4%. The Dow up 0.2%, and the Nasdaq up about 0.4%. Yields pushing a little bit higher as well. 10-year Treasuries up about 4 basis points, 3.95% on your 10-year Treasury. The 2-year is at 4.45%. This is Bloomberg. All right, let's get some company news right now with Lisa Mateo.
Thanks, Paul. Union workers at the world's biggest brewer have voted to authorize a strike. We get those details from Bloomberg's Steve Podisk.
99% of union workers at the 12 AB InBev breweries in the U.S. voted to walk off the job if a new contract isn't secured by the time the current agreement expires at the end of February. Teamsters President Sean O'Brien says if Anheuser-Busch's executives can't negotiate an agreement that respects workers, they'll see them out on the streets. The union is seeking higher wages, better health and retirement benefits, and job protections for its 5,000 AB InBev members.
Now, shares right now, they're a bit unchanged. To tech, where a consortium backed by Clear Lake Capital and Insight Partners has agreed to buy software developer Alteryx. Now, it's a deal that values the company at $4.4 billion, including debt. Alteryx shareholders will receive $48.25 in cash for every Class A or Class B common share that they own. And we checking in with those shares right now. They're down about 2%. Apple shares, they're lower this morning, too, after a report from 9 to 5 Mac that the company will halt sales of its Apple Watch Series 9 and Ultra 2 models in the U.S. Now, this follows an ITC ruling that was part of a long-running patent dispute around the device's blood oxygen sensor technology. Devices will remain available for purchase from other outlets. That includes Amazon and Best Buy. Apple right now is down about 1%. And it's the end of an era for the poster child of pandemic-age stock darlings. Today, Zoom Video Communications, no longer part of the NASDAQ 100 index. The stock has underperformed every major equity benchmark in 2023. Zoom is down just a fraction. Those are the company stories we're following this hour. I'm Lisa Mateo. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
We're coming up to 11:22 on Wall Street. I'm Nathan Hager. We check the markets all day long here on Bloomberg. Stocks are firmly in the green now, despite some of the pushback we're hearing from Fed speakers that interest rate cuts could come early next year. The S&P 500 right now is up 20 points, or about 0.4%. The Dow Jones Industrial Average is moving higher now, up 79 points, or 0.2%. And the NASDAQ is up 48 points, a third of 1% gain for the NASDAQ composite. The 10-year Treasury is down 11/30 seconds, yield 3.95%. The 2-year is at 4.45%. NYMEX crude is up 3%, up $2.16 at $73.59 per barrel. COMEX gold is little change now, up 50 cents, trading at $2,036.20 per ounce. The euro is at 1.0917 against the dollar. The yen is at 143.03. There may be yet another benefit from Ozempic and other weight loss shots like it. A study in the journal Cell Metabolism says GLP-1 medications activate anti-inflammatory pathways in the brain that could lower the risk of heart disease. Eli Lilly also makes a GLP-1 known as Zepbound. Shares of Ozempic maker Novo Nordisk that are traded on Wall Street are up 1.6%. Eli Lilly up 1.1%. That's a Bloomberg Business Flash. Bloomberg Markets continues with Paul Sweeney and Jess Menton.
All right, very good. We appreciate that. And it's just interesting that these markets here, 0.4% higher on the S&P 500, marching higher. So
Can I also add, the S&P 500 is just about 1.2% away from an all-time high.
Yep, amazing, amazing. Nathan Hager, thank you so much. We appreciate that as always. Let's talk emerging markets. And we usually talk to Damian Sassar, but thankfully he's working from home. He's mailing it in yet again.
So we did,
which is certainly the better half. We got the A team here, the people actually do it for a living. Penny Foley, managing director for emerging markets for TCW, joins us here in studio, so she gets a special gold star there. Penny, how can I play emerging markets when my biggest emerging market is China, and I have no idea what's going on in China? How do you guys think about that from a 30,000-foot level?
Well, we focus obviously on fixed income. China is actually a relatively small part of the index.
Okay.
It's about 4%. And we're typically, that's the dollar index, and we're underweight China. Okay. We use corporates to some extent, which are pretty defensive, shorter maturity, higher ratings. So that would be how we play China in the dollar market. In the local currency market, we've used China as a funder, largely low, it's at low yields. The currency's been relatively stable, so that for us is a funder. If you look at EM as a whole, the growth rates this year have widened relative to DM growth rates. We expect the same in 2024, and that excluding China. We expect growth to really remain pretty much the same from 23 to 24. So I think the fundamentals are pretty attractive in these markets. If you look at the world from a debt perspective, debt peaked at about 62. This is excluding China. Debt peaked at about 62.5% in 2020. We expect it to be about 56% by the end of 2024. There was a lot of concern about defaults at the beginning of 2023, and that concern continues. There are about 17 countries in EM that don't have access to the public markets, so those are clearly candidates. Of those, 8 have maturities in 2024, and we expect 7 of those will be able to make it through with funding from the IMF and other sources, local markets as well. The only one that is at risk is Ethiopia, which obviously just announced their intention not to pay.
How do you view emerging markets that are commodities-driven emerging markets versus the rest that aren't as closely tied to commodities as far as what their economic outlook looks like next year?
I think that one of the things to think about in emerging markets is the index today for EM fixed income is about 70 countries plus. So they're all over the place. It used to be back in the old days when you could just say this is a trade where we're going to have compression of spreads, and everybody was pretty much in the same area. We had 10 countries in the index in 2000. You had 30 in 2008, and you have over 70. So it's very much a game of differentiation. And so in our strategy, we're about 40 countries in that. So we really are ignoring about a third of the index. And there are countries that are in the portfolio because we like the local story, and Mexico and Brazil are two that benefit both from local story as well as in the case of Brazil is commodities, and in the case of Mexico, it's really nearshoring into the U.S. So those are two countries we like very much.
What else besides those? How risky do you go out in your kind of profile for emerging markets?
Well, I think one of the things that is particularly interesting about EM is those countries that are, that have tried every bad idea in the, in the book, and they run out of options. And that's what we call a significant turning point. And that can be driven by just hitting the wall. It can be driven by a change in administration. Argentina is a good example right now of a country that could well come out from a couple of decades of bad management to a better environment, and it's it's still relatively cheap.
So how are you positioning for Argentina, for example? Because that really was in the news most recently.
We're overweight Argentina pretty significantly. We have a strong EM Latin America strategist he's Argentine, and he suffers from a negative bias. Right. But he's been very positive about Argentina and the outlook under the new administration.
You look at some of the data under Bloomberg Intelligence, so Gina Martin's Adams team, they're looking more at what happens with the equity side of things, but especially looking at how emerging markets are definitely primed to lead when they're looking at some of their global counterparts, just because, especially from an earnings perspective, they have gotten hit hard in the past few years. How do you view that going into next year when you're looking at emerging markets versus other countries globally?
Well, I think EM went into a downturn a little earlier than the developed world,
right?
And they're coming out a little earlier. They started to increase rates really a year before the developed world, and they're in Latin America and in Central and Eastern Europe. Rates are coming down. We expect that to broaden out over the course of 2024. Inflation is coming down faster than it is in the developed world. So right now you have about a third of countries that have services inflation pre-pandemic levels, and 2/3 goods inflation pre-pandemic levels.
So you mentioned Central and Eastern Europe, and of course, a lot of geopolitical risk there that you and other emerging market folks have to deal with. How do you think about that part of the world here? Is it just too risky given what's happening in Ukraine?
No, we are neutral, the region overall.
Okay.
The CE3. We've taken our overweight in Poland, which also is going through a transition, a government transition, which could be positive. And we're less excited about some of the other countries in the region, which are going, in our view, in slightly the wrong direction.
There's been so much debate about the Federal Reserve potentially having to maintain a hawkish stance, even on the back of what we obviously heard from Fed Chair Powell last week, and these Fed officials that have been coming out, leaving the door open to those potential rate cuts in the second half of next year. But when you're looking from a global perspective, do you see anything, even in particular with emerging markets, or anything going on with inflation that you really feel like is a risk and could end up sparking potentially further downside risk to the global economy that maybe investors are underestimating?
I think the biggest risk on the inflation side is really commodity prices and conflict that generate higher commodity prices. Russia-Ukraine obviously shot food prices up substantially. That's come down a little bit since then, and on the conflict in the Middle East has yet to have a major impact on oil prices. But those are two major risks, and oil and food are very heavy weight in the EM inflation basket, close to 50%. So those, I think, would be the big risk.
What areas or situations are you guys avoiding the most? Where's your highest conviction of, like, we just cannot be in this part of the world?
Well, we're pretty much in all parts of the world.
Okay.
Turns out. Right now, we're overweight Latin America, and we're overweight Sub-Saharan Africa. We're equal weight in CEE and also in the Middle East, and we're way underweight in Asia. We find that less interesting at this point.
Underweight in Asia.
Underweight in Asia. We find it less interesting at this point, just in terms of rates are lower. They have less duration opportunities there as well. So our big positions in Asia are Indonesia, India in corporates in the dollar side, India on the local currency side because of its inclusion in the index going forward, and Korea also on the local currency side in expectation for a better external environment and also possibly being included in the WIGB.
We only have about 20 seconds left, but what's the top question you get from your clients?
Well, interesting enough, we're now getting one of our top questions is when do we get involved? If you look at the technicals, we've lost something like 115 billion outflows since the beginning of 2022. So there's most people in my seat are either neutral or underweight, and there's very little tourist capital in our markets. So I think the technicals are really supportive going forward. And in terms of issuance, we expect issuance to be largely IG.
Okay, very good. Penny Foley, thank you so much for joining us. Penny Foley is the Managing Director, Emerging Markets for TCW. Right now, let's head down to Washington, D.C. We'll get World and National News with Immerse.
Thank you, Paul. We continue to monitor that blockbuster storm that's torn its way up the East Coast through D.C., New York, Boston. Now it's headed for Maine, leaving power outages and flooding in its wake. Oil and gas giant BP said it will pause all shipments through the Red Sea following an escalation in attacks on merchant vessels by Houthi militants. We get that reaction from Washington and Bloomberg's Anne-Marie Hordern.
The Biden administration is, of course, weighing what they can do when it comes to these Houthi attacks. One source I spoke to this morning is talking about the fact that within the Biden administration, there is debate about potentially getting involved in a longer-term, protracted Houthi potential conflict. There also is talk of maybe a maritime consortium to be there in the Red Sea to protect it.
Bloomberg's Anne-Marie Hordern. Israel is resisting growing international pressure to call a truce with Hamas. There is an effort to renew prisoner exchanges after Israel's military mistakenly shot and killed 3 hostages in northern Gaza last week. Bloomberg government Zach Cohen has more on that from Washington.
It presents a challenge for the Biden administration to try to walk a balance between supporting Israel in its mission and trying to limit further violence in the region.
Bloomberg government Zach Cohen. The White House has taken aim at former President Trump over his use of inflammatory language to describe immigrants. Bloomberg's Ed Baxter with the story.
The White House says they are un-American. The statement says echoing the grotesque rhetoric of fascists and violent white supremacists. Trump was trying to rally his base around the issue of immigration.
They're poisoning the blood of our country. That's what they've done.
And Trump rival Chris Christie on CBS is heard on Bloomberg.
I don't know how you could take someone like that and say that they're fit to be president of the United States.
Trump continues to hold a massive lead in the polls of the GOP. Ed Baxter, Bloomberg Radio.
Global news 24 hours a day, whenever you want it with Bloomberg News Now. I'm Amy Morris. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
$11:40 on Wall Street. I'm Nathan Hager. We check the markets all day long on Bloomberg, and the rally continues with the S&P 500 up 0.4% or 21 points. The Dow is higher by 70 points or 0.2%. The Nasdaq Composite poised for yet another record, up 54 points, up 0.4%. So stocks continue to push higher, even with the Fed pushing back at market expectations for rate cuts, at least early next year. R.J. Gallo, senior portfolio manager at Federated Hermes, says bonds have rallied even more than he expected.
He thought that the 10-year Treasury might end the year, around 4.25. We're a little south of 4 right now. So the rally was fundamentally based. I think it draws into question some of the dramatic sell-off that we saw previously, but the fundamentals have moved in the bond market's direction and helped to ease fears that the Fed would have to keep tightening. Now the market's probably overpriced easing. That's the new challenge.
Hear more from R.J. Gallo of Federated Hermes on the latest edition of the Tape podcast today. And checking bonds right now, the 10-year's down 11/30 seconds for a yield of 3.95%. The 2-year is at 4.45%. NYMEX crude is up 2.5%, up $1.80 at $73.23 per barrel. COMEX gold is up about 0.1% now, up $1.90 at $2,037.60 per ounce. The euro is at 1.0918 against the dollar. The yen is at 143.06. We continue to watch shares of U.S. Steel. They are up more than 27%, with Japan's Nippon Steel buying the American industrial stalwart for $14.1 billion cash. And Apple is lower by 1.2%. The iPhone maker is going to stop selling the latest edition of Apple Watch Series 9 and Ultra 2 in the U.S. That is due to a patent dispute. That's a Bloomberg Business Flash. Bloomberg Markets continues with Paul Sweeney and Jess Minton.
All right, Nathan Hager, thank you so much. We appreciate that. Jess Minton and Paul Sweeney, we're live here in our Bloomberg Interactive Brokers studio. We're also streaming live on that video thing on YouTube, so head over to youtube.com and search Bloomberg Radio. All right, let's talk markets. Let's talk maybe hedging in markets.
Yes.
That might include some math. I was told there wouldn't be any math, but our next guest, he's got it all nailed down. Amal Darkar, sorry. He is the global head of corporate. He is the managing partner and chairman at Chatham Financial. And he's done a lot of stuff in his career, but for me, the highlight is he's a graduate from Penn State University.
Oh, there we go.
Happy Valley. He's getting ready for the Peach Bowl in Atlanta. Amal, thanks so much for joining us here. I mean, boy, this was a heck of a way to end the year here. What do you make of it, both in equities and fixed income? What's your take here?
Oh, well, thanks for having me on. And I am very excited about the Peach Bowl. We can talk about that later. I thought that was going to be the highlight of December for me, but there's a real dislocation in the markets right now, and I think that is really the highlight to pay attention to. What the Fed is saying and what the market is interpreting are two very different things. We're absolutely pricing in the markets way more rate cuts than the Fed itself is calling for. And time will tell who's right, but it makes for a really interesting market environment for CFOs, for CEOs, for boards to manage from a risk standpoint.
So how are you advising companies to navigate then in the wake of this? Because clearly everybody came into this year, and for the most part, most people ended up getting it wrong when it came to the call about a potential U.S. recession, which still seems like it's a ways off, right? When you look at some of this consumer spending data, but then when you look at what the bond market's saying, how do you rectify those things?
Yeah, and what's interesting is, when we talk to some of the largest companies in the world, we're not seeing a pullback in investment. There's conversations happening about M&A, about organic growth. And so, to your point, it might be the most widely called recession in U.S. and maybe global history. There's a lot of people that will be taking victory laps if and when it happens. But but the rest of the world is moving on as if that's not the case. And from a risk management standpoint and capital structure standpoint, we absolutely have seen higher cost of capital. And that's not a unique story. I mean, you've heard that all year, but we're seeing that cost of capital come down a little bit these last few weeks. And it's a bit differentiated, for investment grade issuers, as some of your other guests have mentioned. It's, still quite a good season, and while cost of financing is higher than it used to be, it's not quite as bad as it was just a few weeks or a few months ago. It's a little bit more tricky if you're on the high yield side to figure out what that cost of capital looks like. And the good news there is that we are seeing alternative sources. You've talked about private credit a number of times. We've talked about private credit. We're seeing lots of different sources of capital. And I think to answer your question directly, what are we advising companies? We're advising them you really need to have a robust capital plan that works in all market environments and be ready for contingencies because it's not about what everyone expects. It's about what happens and how you react when the unexpected event occurs.
Right. So what does that specifically mean as far as allocation perspective?
Yeah, I think for companies, what that means is, as for issuers, it means, thinking about what the sources of capital could be for you. So if you're used to, for example, using term loans, and relying on banks, could there be alternative sources that you could leverage in the private credit realm? Again, for investment grade issuers, it might not be going away from the bond market, but using alternative financing structures and getting a little bit more creative than you had to in years past. And it could involve, looking at issuing abroad. We've had guests, talk about what the FX market has looked like. It's been, an interesting dollar strengthening, dollar weakening run here. But for, those multinationals that haven't actually gone outside of the U.S. for issuance, it might be an interesting time to look at diversifying the investor base as well from a capital structure standpoint.
Hey, Amal, I was just looking at some of your notes here, and you have a study out that in terms of hedging currency risk, I thought pretty much everybody who's got the exposure would hedge it, but that's not the case. Talk to us about that. Oh, might have lost him.
I think we may have lost him there, but it is interesting when you think from a foreign exchange perspective and then the volatility there. But just given, especially with the dollar, right? We talked a lot about how last year when it peaked out in that September, but then we saw that strength over the summer when the Fed had that last rate hike in July. And so we did see that as the dollar had gained some strength there, as the equity market, though, had weakened in August, September, October. But now seeing the opposite of that when you're seeing yields come down, dollar a little bit pressured there, and what that means for equities, Paul.
Yeah, looking at the Bloomberg dollar index, you pop it up for like the last 12 years. A lot of volatility, as you mentioned, kind of reached a yearly low down right around mid-July. So a lot of volatility in the currency space, and we do have Amal back. Amal, thanks for coming back. We appreciate it. We had a little technical difficulty there. Talk to us about hedging currency risk. What do companies do right? What do they do wrong?
Yeah, currency risk is always really interesting. One of the things that we found that's a surprising result in some ways is, public companies are pretty good at managing their currency risk. Well, the ones that do, at least. About half of them don't manage any of their currency risk, which, as you can tell, in 2022 and 2023, that's been a real challenge. What's really interesting, though, is you look at newly public companies. Those firms have, I would say, the hardest time. They're the least mature. And I think that's something investors are going to be paying more and more attention to. There's expectations that, if you take a company public, that you're certainly on a journey to becoming mature. But with currency risk being as significant as it is, with all the geopolitical risks that are out there, I think that's something that investors are going to be asking CFOs and CEOs a little bit more about going forward.
We only have about 30 seconds left, but top concerns from your clients?
Let me answer a different question, which is usually companies are not concerned about commodity prices and oil prices when they're low. So I'll say actually a concern that CFOs and CEOs and boards should have right now is that they're probably in an era of, we sit here in an era of abundance with respect to oil supply, U.S. shale producing record amounts, prices are low, companies tend to take that for granted. So an area of focus that we're seeing is proactive CFOs really pushing forward and coming up with strong commodity hedging plans.
Amal, thanks so much for joining us. Really appreciate it. Amal Dagalkar, he is the managing partner and chairman at Chatham Financial. We appreciate getting some of his thoughts. He is a Penn State grad, so getting ready December 31st, the Peach Bowl against Ole Miss, Penn State. We're going to more coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
You got it, Paul. The Department of Transportation has slapped a hefty fine on an airline carrier for violating consumer protection laws. Bloomberg's Gina Cervetti has those details.
Southwest Airlines says it's ready for the holiday rush this year after last year's winter holiday meltdown. Now the company will pay $140 million to settle a federal investigation into the debacle that canceled thousands of flights. That settlement includes a $35 million fine.
Now the DOT said the penalty is 30 times larger than any other consumer protection violation fine that it's issued. Southwest is down about 1.5%. Delta Airlines has extended the suspension of flights from Boston, New York, and Atlanta to Tel Aviv, at least through March 29th. Delta says it's keeping close tabs on the security situation in the region. Delta right now down about 2.5%. North Face, Timberland, and Vans parent VF Corp is working to bring parts of its IT system back online after it detected a cyber attack. Bloomberg's Katie Greifeld has more.
This is an ongoing matter. VF Corp has yet to determine the full